Welcome, everybody. We're live, and we're happy to welcome all of you to our 5th annual Navigating the Annual Meeting and Reporting Season program. We welcome those of you who are in person and the many who are joining us online. About 450-ish people have signed up to join us one way or the other. But thank you, those who were nearby and took the time to come in person. We're glad to see you. My name is Robert Kimball. My practice focuses on capital markets, corporate governance, and mergers and acquisitions. We have a few housekeeping items that I'll just need to check my notes on to make sure I get right for you. A lot of these are primarily for those joining us by webcast. On the webcast, you should see the speakers as well as the presentations on the screen, but if you're on a mobile device, your view might be modified. All of you are welcome to ask the panel questions as they present. To submit a question, please use the Q&A icon at the bottom of your screen if you're online. Just raise your hand if you're here. We'll try to answer questions during the presentations if time permits. And if we don't get to your question, somebody will follow up with you. This is a CLE accredited course, including an hour of participatory ethics for lawyers. If you want credit, please keep an eye out for the polling questions that will pop up on your screen during the presentation. Those of you here in person should have signed in at our reception, or you can sign in later during breaks if you need to. You will be alerted if you're online via the chat when a polling question is live. So please pay attention to those so that you can get credit for it. Now, again, if you're here in person, please remember to sign the CLE registration forms here at the entry. Eat as much as you want of our food. If you need directions to any place or help with anything, please, even if it's a quiet place to take a call, please talk to our great team at the reception area and they'll take care of you. As we have in the past, we'll send a prize to whoever catches the best typo and, the best typo catch, not the best typo, the best catch of a typo, and the best substantive correction to our slides. So submit your entry through the chat room or by email during the program or until 6 p.m. Today, Central Time. We welcome your suggestions on how to improve the quality of this program, and we welcome your suggestions on topics you'd like to see in the future in this program or in other programs. So please feel free to communicate that to us. With that, let me get us started into our first panel on disclosure updates, focusing on SEC and executive orders, a few other odds and ends we may feel inclined to mention. My co-panelist is Mike Telley. Mike, if you'll introduce yourself and get us started off.
Yeah, thank you. Appreciate everyone's attendance today. We're going to start. This first panel is a shorter panel, about 20, 25 minutes, just to sort of hit the high points, kind of an overview of some of the key topics. Many of these topics will be talked about in greater detail on later panels. So don't worry if Robert and I in this panel don't hit the topic at great enough depth. It's going to be covered in a subsequent panel.
Our biggest goal here is to make sure you have what you all want is, did I miss anything that I got to do in my 10K, my annual meeting this year? And so this is sort of, in a way, our checklist presentation.
Exactly. High-level checklist of the things you ought to be thinking about. So we thought we would start by providing just an overview of the current regulatory backdrop. And depending on your outlook, the backdrop has improved significantly. A lot of, as soon as President Trump took office, deregulation of the SEC commenced right out of the box. Just shortly after, we got Staff Legal Bulletin 14M, which I think caught a lot of people by surprise because it literally came within a few weeks or a month. And that the effect of that was to rescind Staff Legal Bulletin 14L and make the exclusion of shareholder proposals related to ordinary business matters easier for companies to accomplish. And that trend has continued with the administration focusing on, getting rid of regulations that are viewed as sort of burdensome and overly, complicated disclosure, and focusing more on, reducing barriers to capital formation and making capital formation easier. They've also, on the enforcement front during the Biden administration, there had been a huge emphasis on, regulation by enforcement, where the SEC enforcement staff would go after market participants or companies, based on the staff's or the commission's, sort of view of what they wanted the rules to be rather than necessarily what the rules were, which it ends up having a chilling effect on activity and causing people to conform their conduct to sort of what the enforcement activity is. And a lot of that has ceased and has been replaced by more bread and butter enforcement activity that's focused on insider trading, accounting fraud, true securities fraud situations. I got to remember to keep up with the slides here. And then as you'll see, what we're going to cover in a later part of this panel, the SEC publishes its rulemaking initiatives and priorities, and that list of proposed rulemakings that are coming down the pike have generally been rewritten. Previously, there were initiatives to, enhance the human capital disclosure, enhance disclosure on board diversity, and those have all been replaced with things focused, as I said before, on capital formation, like liberalizing Rule 144, rewriting or liberalizing the accredited investor definition and making it easier to qualify as an accredited investor. So overall, the regulatory landscape has changed pretty significantly, and should make us give us a chance to sort of catch our breaths and hopefully focus on actual capital formation transactions and not more burdensome disclosure writing that was sort of the case over the last 4 years.
There are some countervailing trends. It's not all a one-way ratchet from the administration. For example, the SEC issued a concept release on foreign private issuers that actually is intended to potentially increase regulation. The concern that they have, and this seems perhaps directed to China in particular, but it picks up a lot of other jurisdictions, the concern they have is that foreign private issuers have a lighter reporting regime than domestic issuers. And there are many foreign companies that take advantage of that without having any foreign market presence. Their only trading market is the United States. And so the SEC has raised the question of whether we should include a market presence or substantial market interest type of test to determine whether or not somebody should be treated as a foreign private issuer. Now, this could flip the other way, and perhaps some foreign companies that currently have to do domestic reporting might come out of that and perhaps get the benefit of foreign private issuer reporting because their primary trading market is outside the United States. So that's one. And then there's some regulatory rollbacks that at least some of us in the room would like to see, but the reality is they're limited by statute. There's a fair number of things, say on pay votes, say on frequency votes, pay versus performance disclosure. By the way, does anyone on say on frequency get anything other than an every year? I mean, are we just great example of a waste of time, but you can't change it without having Congress act and amend the law. CEO pay ratio, conflict of minerals, mine safety, payments by resource extraction issuers, periodic reports, the duplication of the certifications by the CEO and the CFO that goes all the way back to Sarbanes-Oxley. These are statutory issues where the most we can hope from the SEC is to at least try to reduce some of the complications of the rules and reduce how they have to be applied. So With that, let's move on, Mr. Telly, to some of the executive order effects and concerns.
Right. So this, I think what we wanted to touch on here, this is, tariffs have been a big topic since Liberation Day, and I believe it was March. They've been in the news, get a lot of airplay. Most of the people attending this program are probably not, export specialists. Our job is to understand tariffs well enough to help our clients and companies come up with appropriate disclosure as to the impact of tariffs on their business. And sorting the landscape is difficult because the tariffs, they change a lot. They change frequently, sometimes with very little notice. And then also different companies are affected differently by tariffs. So for folks in our position, we have to understand our clients and companies, to what extent is our business affected by tariffs? What is the scope of the tariffs effect on us? And then secondly, once we understand that, the next question is, are there mitigating effects that might reduce the impact of those tariffs, such as the ability to find another supplier, or the ability to pass on tariff cost increases to the customer, or the ability to raise prices? And then once that's all understood, you can kind of understand, okay, this is the bottom line result of tariffs on my client's results of operations. And this is how I need to start thinking about how to disclose this. And that disclosure is going to probably appear in MD&A. It's going to probably appear in risk factors. It probably appears in the forward-looking statement disclaimer as an uncertainty. And so really, I think that's the hard part of our role, is to try to get to the bottom of really how tariffs are going to impact us and make sure our clients are including appropriate disclosures to tariffs. There's a KPMG study that came out recently that talks about the fact that early on, tariff disclosure was fairly qualitative. People would just talk about the uncertainty associated with tariffs. Over the last couple of quarters, that disclosure has gotten more granular. It's more quantitative in nature, with companies trying to actually scope out exactly, what segments are being hurt the most by tariffs, and, trying to sort of approximate the financial impact. There is a recent piece of litigation. Dow Chemical Company was sued by a group. It's a class action lawsuit that was filed this fall, and it was based on the company's disclosures related to tariffs. The case is in its early phases, so we really just have the facts as asserted by the plaintiff. We don't have the full story before us. But if you read the complaint that the plaintiff filed, management did acknowledge there were chemical industry macro headwinds. They also acknowledged that tariffs were going to potentially be a challenge, but their disclosures highlighted a lot of positive attributes about the company, and the fact that the company was well positioned to weather tariffs. And some of the quotes that were in the complaint were, and the company also has what they tout as an industry-leading dividend, but they talked about the fact that they had an enhanced focus on operational discipline, a differentiated portfolio of assets, low-cost feedstock position, a purpose-built asset footprint, and an agile supply chain. So they used all these all this sort of corporate speak to talk about how their business could weather the tariffs. They got to the second quarter of 2025, announced very poor earnings relative to market expectations, and also announced they were cutting their dividend by 50%. And this lawsuit filed shortly thereafter, and the lawsuit alleges that they made false and misleading statements and misled the market into thinking that the company was well positioned to weather the macro headwinds and the tariffs. And we'll have to, obviously that's just the plaintiff's side of the case. That's not the defendant's side of the case. I'm sure they had good risk factors and other disclosures that may mitigate some of these claims. But point being, this is kind of a critical area for us to all think about, and it's not just rote disclosure. It requires understanding the landscape and getting into the weeds and really understanding the impact on our clients and companies.
Thanks, Mike. Yeah, that's one where every every company is going to be affected differently. We want to revisit for a minute something that happened toward last year end, and that was the Fifth Circuit vacating the SEC's approval of the NASDAQ board diversity rule. We know since the election that proxy advisors have pared back on some of their diversity metrics. We've seen a lot of executive orders about DEI type initiatives, but mostly focused on enforcing the anti-discrimination laws. So some things that are going on. When the Fifth Circuit vacated it, it said a couple of things. One, that the SEC exceeded its authority under the 34 Act. And it focused particularly on the notion of, regulation by disclosure can become actual regulation. The SEC often denies this and says, no, we're just mandating disclosure. We're not telling you how to do things. But in practical reality, we all know that if you get something that says, tell us your, sexual orientation and racial makeup of your board and tell us why it's not diverse or doesn't have these kind of folks on it. When you get to that level of specificity, that pushes people to make sure that they don't have to make the why not disclosure. So we've seen that in so many areas of how it affects behavior. And what the SEC said is they didn't explain how the rule satisfied the purpose of the 34 Act, focusing on protecting investors from speculative, manipulative, and fraudulent practices and promoting competition for securities transaction. Just didn't believe that it was sufficiently related to those goals from the 34 Act. The other thing it said, and part of the reason we mentioned this is because these two lines of argument are going to be high focus in many of the discussions at the SEC and in court cases, and just theoretical around the whole area of SEC regulation. The other is the major questions doctrine. If there is a action that is economically and politically significant, this Supreme Court, I think, but certainly the Fifth Circuit, believed that meant that you have to have congressional authorization to act, and that authorization needs to be an unequivocal statutory text. And we've already seen that doctrine show up in cases farther afield from securities law disclosure. So that's probably where some of the battle lines will be drawn. We saw people scale back their use of the words DEI or ESG. Risk factors still continue to address those kinds of things. There's still line items out there that relate to this, such as the human capital related areas and the committee's process for identifying and nominating directors. Some companies, this is just a relabeling, a refocus. It's still there, the same as it was, but maybe more hidden from the public verbiage. Others, it's enabled some changes in what they're doing. These will last while this administration is in. Whether they will last beyond this administration is anybody's guess. So don't think you're free of this forever. I think that's the question. Is there a substantive change or is it less obvious? And if I were a litigator in some of these, if it looks like there's been a substantive change because of the words and there hasn't been, does that itself create a securities law cause of action under the theory that anything can become a securities law cause of action if it might have affected disclosure? So any side of the political battle has some teeth here to continue in the fray. SEC operational status, we're all pretty hopeful that Congress will not be delayed in flying back to the nation's capital, that they'll all get there and that they can figure out that it's okay to reopen the government and figure out a better way to resolve some of these issues. But the SEC followed the pattern of prior shutdowns for the most part, but actually expanded a little bit in one area. It took people who are not well-known seasoned issuers and freed them up to do a little more in their offerings by reinterpreting Rule 430A and the need for pricing information up front. And so that's a very helpful piece of guidance. Whether that plays out into daily practice after the shutdown ends and they do some rulemaking to facilitate access to capital markets, and this is an indication, I don't know, but at the minimum, we hope that at least provides a roadmap for next time. Unfortunately, expecting there will be a next time to keep capital transactions moving forward. So let's go to the very short checklist. And Mike?
Yeah, so this, apologies. So I think, Robert, you were going to talk about Edgar next, which hopefully everybody in the room has figured out is now the regime we have to deal with relative to the old Edgar Filer status.
So if you've never, this is all I'll say. If you've never heard the words Edgar next, read this slide and go get it done because you're late.
Yeah. Okay. And then I'm going to talk about the climate disclosure rule, which, as everybody probably knows now, there was litigation pending. The rule was promulgated in final form. The SEC stayed the effectiveness of the rule pending litigation. That litigation was pending in the Eighth Circuit. Following the election, the SEC was directed to cease defending the rule. I believe the rule that this litigation is still technically pending, but conventional wisdom is this rule is never going to become effective, and we don't need to worry about this iteration of the rule at the federal level. There is, however, there are, however, several states that have adopted similar rules. California is the most notable one. There are also climate disclosure regimes in other countries, Canada and the EU. And so climate disclosure is going to be around in some form or fashion for most companies to think about. A lot of companies provide some voluntary disclosure. There are several organizations that have voluntary disclosure regimes with forms of how particular information should be disclosed, and a lot of companies provide that information voluntarily. So this is one that's probably not going away, and I believe John Sorlizano is going to talk about this on a later panel, but that's the current landscape right now.
Don't forget that before this rule was proposed, there were also lots of shareholder proposals about various forms of climate-related disclosure, environmental disclosure. Companies may have already made undertakings that they don't get to just throw out the door because this is not happening at the SEC. And the investor interest and expectations will continue to shape what disclosure companies choose to do.
Okay, jumping forward to some reminders from 2025. These should hopefully be familiar to folks. For those involved in the upstream part of the business, the energy business, we have the resource extraction issuer rule. This September of 2025, companies should have filed their second Form SD report, which is the report that you're required to file if you're a resource extraction issuer. That rule generally applies if you're engaged in the exploration and development of oil, natural gas, or minerals. The rule, that definition also includes the term processing, so it has the potential to pick up some midstream companies and midstream activities. And there really hasn't been any interpretive clarity on that. And basically the rule just requires that all payments made to the U.S. federal government or to foreign governments need to be disclosed on Form SD. And the other thing to note here, we're in our second year filing this form. We really haven't seen much in the way of SEC review or comment on these Form SDs that have been filed. So no real guidance yet as to whether companies reviewed by the SEC is chinning the bar. Probably not an area of focus for this administration. but eventually, there may be some initiative to start reviewing what people are filing and start issuing comments on it.
We did see the final SPAC rules in early 2024 at a time when SPACs were getting a lot of negative market attention. So far be it from the government to stay away from those kind of things. They adopted disclosure rules that were mostly redundant of market practice already. But they added a bunch of concepts allegedly to put de-SPAC type IPOs on an equal footing with IPOs, but in fact probably made them disfavored from a regulatory perspective by adding underwriter liability potentially to people who don't otherwise have it, creating some confusion about when a SPAC may be an investment company. There's a continued ongoing application of Rule 144 to de-SPAC securities that is way out of line with any other company. And then they've, of course, got foreign private issuer and emerging growth company definitions that treat SPACs differently. So nevertheless, SPAC activity seems to be recovering because of stronger governance, longer timelines, 30 to 36 months instead of 18 to 24, and performance-based incentives tied to stock price and some more or less tighter vetting looking for revenue-based companies. So those things have brought the market back somewhat in the SPAC and de-SPAC area.
Yeah, and then I will also touch on quickly the changes that were made to the 13G beneficial ownership reporting rule. These are all now effective and have been for approximately 1 year. So hopefully everyone has been in compliance with them. Previously, the deadline to file a Form 13D or a Schedule 13D was 10 days after acquiring ownership or losing eligibility to file a Schedule 13G. These amendments changed that deadline to 5 business days. Previously, amendments to the form were required promptly. Now they're required within 2 business days. And if there are 13G filers out there, previously 13Gs were filed within 45 days after the end of the year. They're now required within 45 days after the end of any quarter in which a material change occurs. So a lot of these are sort of simple changes that are easy to look up and comply with. You just got to remember that the rules you grew up knowing have changed, and now there are different deadlines to comply with.
Let's just take a minute to wrap up with some outlook. So a couple of graphs on proposed rulemaking. Surprisingly, actually, there have been more SEC rules proposed this year than in the first term of the Biden administration, which seems counter to the deregulatory thrust, but very, very few of these directly affect publicly traded companies, public reporting companies at this stage, and some of them are deregulatory proposals. There's a lot of market plumbing going on in there. Foreign private issuer eligibility, I mentioned earlier. There's a lot of work on the consolidated audit trail. I think you all know that PCAOB is a little bit of a hot button at the SEC and whether it makes sense because of the way it's been altering, call it auditor sensitivity to issues and making them a bit jumpy because of the second guessing and the publishing of reports. The Rule 144 Safe Harbor is just a reproposal of a 2021 proposal that mostly had been adopted, and probably this part is not likely, the actual proposed rule is not likely to affect most of us because it's a holding period for conversion or exchange of market adjustable securities of issuers not listed on a national securities exchange. But we are expecting other proposals down the road potentially about the operation of Rule 144, trying to extend ECG and non-accelerated filer benefits more clearly and more broadly, improving our shelf registration processes, and a whole lot of disclosure things, including, as you'll hear, executive comp, potentially simplification, and rulemaking in the shareholder proposal area. So that, I think, actually, we're going to skip the AI-related disclosures. We've got a slide here for your trends. I will just note that if you read the SEC's very positive statements about what it's going to do with AI, you wonder whether it would not be the target of a AI washing. That's the new phrase in the Division of Enforcement, an AI washing piece of litigation, because they really are stating that pretty broadly. And then the last slide is actually the retail voting, which our next panel will address. So we're going to take a 7-minute break.
We have one question, Robert.
Oh, we have a question. I'm sorry. Yeah, conflict mineral disclosure will remain in place. That's statutory. So the most we can hope for is a modification of the rule itself to make it easier to comply with. But we've got to have Congress get on board. So feel free to write them. Okay, thank you. There's a group coming in to clear off the lunch stuff, and we'll reconvene here at 12:40, starting promptly then with our new panel. Thank you.
Thank you.
Can I please ask everyone to take their seats as we want to continue and start with our next segment? Thank you very much. Well, it's great to see that apparently the preceding panel sparked some discussions already, which is always great to see people connect. And we'll hope we'll make this equally interesting here. We're going to touch upon shareholder engagement, investor environment, and shareholder proposals a little bit in the next hour. My name is Sebastian Tiller. I'm a partner in V&E's New York office. My practice covers private public M&A, board advisory, and shareholder activism. And I'm delighted to have with me here on the podium Jessica McDougall and John Solorzano. And I'll ask them both to introduce themselves.
Sure. So I'll get started. I'm John Solorzano. I'm a partner in V&E's LA office. I head up our corporate governance and sustainability practice. My role largely involves helping public companies, their boards of directors, on issues related to disclosure, shareholder engagement, and things of that nature. So really excited to have this conversation today.
Yep, likewise, happy to be here. So thank you all for having me. I'm Jessica McDougall. I lead the corporate governance and shareholder engagement practice at a firm called Longacre Square, which is a strategic advisory and communications firm. We work with companies across a range of issues involving their shareholder base on how to talk best to them, key proxy voting policies, trends and changes in the governance landscape. And my background is largely in this space, having spent most of my career at institutional investors, both TIAA, CREF, and BlackRock. So thanks again.
Super. Thank you both. Well, in our first segment, we're going to talk a little bit about sort of what happened during the 2025 proxy season. As everyone is aware, earlier this year, I think it was around the beginning of this year, the SEC came out with revised guidance for 13D and 13G filers, putting some pressure on people who typically have relied on the passive, filing a 13G rather a 13D among many passive investors, obviously. And as a result of that, that guidance, as I may say, a little casually, like that caused a stir, to say the least. And we don't want to dive into the actual guidance. We really want to look a little bit and pull the thread of what happened. What have we seen over the last 6 to 9 months? And maybe, John, we'll start with you. So what's your experience? What have clients, what have you seen among our clients? What have you seen largely in the landscape?
Yeah, so without getting too deep into the weeds on the developments around 13G and 13D, they were alluded to a little bit at the end of the last panel. However, largely large institutional investors, the large index funds, the big three in particular, the BlackRock, Vanguard, State Street, have availed themselves of the 13G rules, which allow them to basically make very bare bones disclosures around their holdings, much less accelerated than a 13D, a typical activist. Under the new guidance from the SEC that came out earlier this year, there was the kind of argument that was laid out that merely implying or using the voting pressure that these large institutions hold might indicate that they are acting in an activist capacity as opposed to a passive one. And so that has significantly changed the way that these traditional index investors have thought about the world. And also, I think, frankly, it scared a lot of the big institutions who are basically fundamentally not set up to do these types of filings. And Jessica can speak a little bit more about like the details involved in that with her time at TIAA and BlackRock. But that significantly changed the way that these large institutions were willing to engage with investors. So, you know, if we back up a few years, the ESG kind of wave that was growing in importance probably from like 2017 on to about 2022, these large institutions were getting a lot of, you know, depending on where you sit on the ideological spectrum, a lot of support or flack for kind of pushing ideological outcomes for a lot of corporates, whether that be on DEI or on ESG metrics, sustainability in particular, and obviously governance. By criticizing the influence that they have, they became a little bit more reluctant to kind of exert their power. When we're talking about these large institutions, upwards of 30% of a given public company shareholder base is comprised of largely three, maybe you know, a handful of investors. Now that this new rule has come into effect, that has made large institutions much more reluctant to engage deeply with companies because they don't want to trigger the perception that they're being active. So that's changed the game as it relates to shareholder engagement. So, you know, again, Jessica, feel free to jump in at any time, but largely companies have recognized it's important to engage with their shareholders for years. They've understood it's important to make friends. It's important to kind of explain your story and have these really robust two-way dialogues with your investor base. That's been best practices. A lot of people probably in this room or watching online have led off-season shareholder engagements with your large institutions. You've probably, hopefully, had a very productive two-way dialogue to learn a little bit about what the investor thinks about the company and kind of explain a little bit of the narrative of what the company is prioritizing, whether that's, you know, how the board is structured, how things within the boardroom work, shareholder rights, executive compensation, things of that nature. Under these new rules, I think that the large institutions are just a little bit more reluctant to exert overtly their feelings about certain things. And so these engagements have changed. The cadence, the kind of rich dialogue has probably abated. And so once these new rules came out, I think it put everybody particularly in the big three on pause. There was an initial freeze on these engagements at some of the big investors because they didn't want to trip up these new 13G regulations. I think that it's kind of resumed into a new normal. Often, if you are still engaging with your investors, you're going to have a different experience where they're going to probably start out with the script that their legal department read saying, we are not activist investors. We are not intending to, you know, demand that you do certain things or whatever that script may be. And the dialogue arguably could be a little less two-way. It could be a little bit more listen mode. And so that's what we've been seeing. I think it's probably a little bit overstated though, Sebastian, because now that I think the institutions are getting more comfortable with the new normal, two-way dialogue is resuming a little bit, but it certainly has.
Yeah, let's pull a little bit on this thread and be a little more like, let's dive and look into this a little bit, Jessica. So John, you said, I heard, okay, people come in with legal disclaimers, fine, right? They're a little more reluctant to ask questions, fine. But what else? What else have we seen, Jessica? What have you seen over the course of this proxy season? What has changed?
So, there we go. So I think the biggest thing, and maybe just to take a step back a couple of years, so maybe if we take it back to 2017 was when BlackRock, Vanguard, State Street really started to build out their stewardship teams as the concept of engagement and proxy voting as being good stewards of assets that, you know, we're in index funds for the most part. Don't have the ability to buy in and out of a stock, but by having an engagement team, you're able to have a voice into a company that you essentially need to own forever. And so that dialogue of shareholders sharing what they thought was best practice Many of it was just standardized governance best practices, but also really trying to understand how the directors were best suited to oversee the company, the skills and expertise they brought, and using that dialogue to make informed voting decisions became very much part of this ecosystem of stewardship, proxy voting, and engagement. And one of the reason why this change this year was so seismic was because that component of proxy voting and engagement there was a wrench thrown into it, essentially. Stewardship teams use the dialogue with companies to make informed voting decisions, is how it was positioned. All of the big asset managers have publicly posted proxy policy guidelines that give a sense of what they're looking for companies to have within their governance structures or best practices. But those individual dialogues really help to give color on how a company really was acting in practice. Did the director, have their finger on the pulse of the company in a way that was believable for shareholders to want them in that seat? And with this change, as we've said here, that dialogue really just became kind of a one-way announcement for companies to, particularly going into proxy season, they were seeking that feedback from their shareholders so that they knew what to expect, perhaps when the vote came in, or perhaps what they could do better next year. But instead, they were left without that feedback loop for fear that these passive funds would be seen as, quote, trying to seek control in a way that just had become part of their team's responsibilities. And as we've mentioned, there were disclaimers from both the investor side. Companies also, said their own disclaimers so that everyone was in agreement. No one is seeking change of control here. We are trying to have a dialogue in a way that we now have to have a dialogue. But it really did catch some companies off guard when they were hoping to be able to explain themselves in a more fulsome way than what was presented in the proxy, but then either didn't get that opportunity because engagement requests were declined or because they just weren't able to have that dialogue. And so some were shocked as to how their annual meetings turned out. And others, who had their meetings a little bit later, if they had to file perhaps in late April, they were able to ramp up their disclosures a bit to help fill in the color where that conversation was lacking.
So going into the next season, if you had someone call you and say, how do I navigate this? What are sort of the practical considerations? We need to be prepared that they walk into the conversation with a legal disclaimer. Are they reaching out? Can you count on the passive investors reaching out to schedule, or do companies need to reach out? What are the practical implications? What do we think? How does this unfold in the next season?
I'll start off and then John, you can add in color as well. But, it's what we speak to our clients about is that where you want to speak to your shareholders, go ask them for the conversation and come with an agenda, seek to, hone your conversation around a certain topic that you'd like to focus on. It can't just be a general, just a general overview. And you certainly can't rely on that conversation to be carried through just normal banter anymore. So it's definitely recommended where companies, as they need to maintain that relationship with their shareholder base, even though it is different, to make the effort, identify the areas where perhaps their annual meeting showed a vote outcome where shareholders were providing feedback on directors or the compensation package, or to, give shareholders a heads up as to what they might be thinking about, from governance changes, updates to bylaws, new directors perhaps, or skill sets that they're seeking to add to the board. And the whole reason why it's in a company's interest to do this, to spend, the handful of hours to go engage with their largely, these conversations are mostly geared towards passive investors, because the conversations with active investors just have a little bit of a different cadence around earnings. But it's so that should you ever need to call on your shareholder base, it's not the first time you're asking them to take your phone call. It's something where you've had an ongoing dialogue. You've presented yourself as a company who understand what's important from a governance perspective, and then is also able to kind of follow through on what those asks might be, or what those generally accepted best practices might be. So even though the dynamic on the shareholder side has changed, it would be my recommendation, and what we talk to clients about all the time, take the effort to reach out. You might not get your call accepted, but at least you have a record of attempting engagement.
Yeah, I would echo that. I mean, there has been a noticeable decrease in engagement meetings that are accepted year over year. I think I have some data here. It's BlackRock's down 28% and Vanguard's down 44% year over year. So it's It's noticeable. I mean, that's a palpable difference. But I think to Jessica's point, every company should still feel that they should reach out. You might get, a polite declination or a no answer if you ask for these meetings. But it is very important to maintain these relationships with your investors. I always say it's better to make friends when you don't need a friend, as opposed to when you do, because in the heat of like an actual activism situation, and if it's the very first time that you're talking to, one of the successors to Jessica at BlackRock, they're going to be a little bit more critical about that. So, bringing a director along, bringing your chair along in a time of sunny day is still worthwhile, but you shouldn't get disheartened if you aren't able to get the meetings that you maybe were able to secure a year or two ago. I still think it's worth the effort.
So I think then, just wrapping this up a little bit, companies should continue to engage with their large institutional shareholders. You have to take the initiative. That's what I'm hearing, right? That's our consensus. Don't count on them calling you. You need to call them. You may not get a meeting with everyone, but if you get that meeting, try and continue to engage and explain sort of your disclosures, your company's strategies as it's reflected in your public disclosures. Provide that color context, solicit questions. I think that's a fair point, right? Even if it's just as a matter of record, you may not get all the answers because people may shy away from sharing their perspectives, but you may get some perspective. And explain the strategy. I think that's the best you can do at this point. Do we think that the pendulum may swing back a little bit? I've heard also voices, like when you talk to other practitioners, some people say, well, it's not, wait a couple seasons and then sort of it's going to be back to normal because the SEC never really targeted the institutional big threes. Sort of they targeted some other people maybe. Is that your view too, or do you think the new normal will remain?
So I'm happy to start. I don't know that the new normal will remain. I don't know that we're going to revert back to the old way either. I think that there's probably a recognition that some of the large institutions were perhaps pushing not obviously pecuniary measures a little harder than maybe society was ready for. And so that I think that there's going to be some gun shyness, even if the political winds do shift. I just don't think that the large institutions are going to put their neck out in the same way that they maybe once did. Of course, pendulums swing, and that's just what they do. And so I think that there will be a different normal at some point in the future. I don't know what that's going to look like. But my expectation is this kind of no regrets, win for the environment, win for, different communities, win for the bottom line. I don't think that assumption is going to be as, widely held as it maybe once was. We I think are just in a much more complex operational environment with interest rates are the way that they are, energy is, following like the Ukraine situation, like it's just a much more complex world that I just don't think that the institutions are going to be pushing the same narrative. And frankly, some of the largest voices who were pushing that narrative have quieted themselves because they've come in under a lot of personal pressure as well.
Yeah,
Jessica, any last words?
I think, I've had the kind of the luxury of seeing this landscape shift over the last 15 years or so. And, certainly I can kind of point back to 2021 when BlackRock policies, which is where I was at the time, were very much focused on climate-related disclosures, on trying to understand how companies were incorporating nature-related risk into their business models, as far as, making sure that natural resources, raw inputs were still available to create their products. And I think all of those items are material for companies in certain instances and in certain business models and in certain strategies. I think the issue became that because there was limited disclosure, the ask for a disclosure against a certain framework, became, it wasn't something that all companies could do in the same way. And so, I think as we've shifted a little bit from a blanket type request for companies across all sectors within a certain emissions profile, the conversation is becoming more bespoke. I don't think these topics have gone away for long-term investors, but more so they're being asked in a way that isn't as generic perhaps, but more relevant to a company and their specific ability to continue to operate and generate long-term value.
The only other thing that I would add to that is I think that in addition to the financial operating environment changing, I also think the legal landscape has changed too. So there was a time when there was a lot of no regrets disclosures that corporate issuers were putting out there, like, oh, we'll set a net zero target, or oh, we'll do this for our underrepresented communities. And that has some real potential drawbacks that maybe weren't there a few years ago, whether that's a greenwashing class action lawsuit or a regulatory investigation from a red state for certain types of initiatives. I think that that's just become a lot more complex of a landscape to be operating in. And I think that investors also understand that. And so maybe they're pushing a little less hard because they realize that companies are kind of caught in this catch-22 where they're kind of damned if they do and damned if they don't. So I think it's just going to be a different dynamic.
So I think if I put myself in the shoes of a company, a public company, and I hear all this, then that just means I have less visibility potentially into what the big institutional investors will do because they won't share as much as they used to. I don't get as much insight of where their heads are. Is that sort of theme of sort of diminished visibility, Jessica, is that issue being compounded now by sort of, the voting choices that the big threes, State Street, Vanguard, and BlackRock make available to their investors? Plus, is that compounded again by the fact that the big threes, the institutional investors, have different stewardship teams? What do you think? Let's unpack this.
So maybe it's not as diminished visibility. We will see the vote result in the end, but maybe diminished predictability as to how things will land as we're in the middle of them. And I think that is because I'll start with the structure of stewardship teams. Several of the large institutional asset managers have split their stewardship teams between a passive voting group and an active voting group. So one representing indexed funds, passive strategies, the other representing active portfolio managers who have discretion to buy and sell over their portfolios. And so what that has meant, as we talked about early on, that for some companies, BlackRock, Vanguard, and State Street represent 30% of their shareholder base. That's not just 3 phone calls anymore. That's 6 phone calls because you need to speak to different sides of the house. The BlackRock team split earlier this year. Vanguard has announced that they'll be doing that for 26. State Street also has several strategies. So it's more phone calls, needing to understand your audience and what they might be looking for in that conversation. We know that, passive stewardship teams may be focused on structural and governance related topics because of, that's their purview, that's the area they focus on, whereas active portfolio managers may be focused in more on a shorter time horizon, interested in quarterly earnings and, like annual projections in a way that the passive side won't. So it's really needing to cater the conversation to the audience that you're seeking to engage with, while also understanding that these asset managers have opened up the ability for their clients to choose how they would like their proxy voting directed. And this was actually a very difficult thing to put into place when these systems first started rolling in early 23 and 24. But the difficulty is that Vanguard and BlackRock, for example, have a significant number of assets under management, largely because of the ETFs that they make available to you and me. And basically you can invest in the investable universe for a very low price. And that also means that you don't own single shares, you own fractional shares of companies. And together, BlackRock has an aggregated holding of 5 to 10% of any public company. But me as an individual, my ownership is so minuscule. But the way that they've built out these options is for individual investors to say, I would like my proxy voting, my fractional share proxy voting to be directed in a certain way. And so that has kind of further bifurcated the vote. So it's not just the 8% block of BlackRock that is going in as a uniform way for the company. It's what the passive side wants, it's what the active side wants, and it's what any number of their clients have chosen from a variety of policies that they've made available to them as to what they want. So this vote dispersion is something that we're seeing more of.
So there's definitely vote dispersion, or call it fragmentation, right? John, what's your take on that?
Yeah, no, I agree with all the points that Jessica made. And then not to overly complicate this, but this is becoming an overly complicated space. The proxy advisors, the ISSs and Glass Lewis's of the world are under their own sets of pressure. And frankly, there was a piece that came out in the Wall Street Journal this morning that I'm sure some of you saw, that there may be an executive order coming down against these two proxy advisors, and that could significantly potentially change the way that they advise their clients if they're allowed to do it at all. So that was very late breaking news, so it's unclear how that's going to roll out. But these large proxy advisors, there's been some allegations that they effectively are a duopoly, which I think is an oversimplification of the way that proxy advisors work. But their say had a ton of influence on proxy voting and also in contested situations. And Jessica can probably speak a little bit more about how those proxy advisory kind of recommendations actually play out in real time. But what I would say is the big three institutions have pretty robust stewardship teams that are actually combing through proxy disclosures and engaging with companies and making decisions on how they want to vote. There are a number of other companies or other investors. Some of them are fairly large, and they might be relatively large within a given company's capital stack. They may be deferring pretty significantly, if not completely, to ISS or Glass Lewis. If ISS and Glass Lewis are now going to have to bifurcate out the way that they vote or recommend for their clients, and Glass Lewis just recently announced a couple weeks ago that they're going to no longer have what's called a house view or a benchmark policy. That's going to further bifurcate out and dilute out the way that investors are going to vote. That is going to continue to lead to just more opaque outcomes, because you don't necessarily now just have to lock in the big three and then lock in the two proxy advisors to understand how your vote's going to roll out, particularly in a contested situation. Now that might be 6 or 10 or 12 different flavors of that, just with those kind of what used to be 5 individuals before. And saying nothing of all the other sort of solicitation activities that you're going to have to do. Where I think that's going to ultimately just net out for companies is vote outcomes are going to be a lot less clear than they maybe once were. Partially going back to the point that we made at the outset with the engagement, you're not going to hear from your investors what they're thinking. And even if you do hear from them, it's not uniform anymore in a way that it maybe once was. So I think that the kind of key takeaway is this upcoming proxy season and probably future proxy seasons are going to be much more unclear than they once were.
So that's an interesting point, right? We're talking about decreasing visibility or fragmentation, dispersions. Those are sort of the key words that I'm hearing. But that's not just a problem for companies, right? That should also be a problem. That should be a problem for activists as well, right? Because if they want to convince the investing public to follow their proposals or their director slate, I think everyone has to put much more effort into the solicitation, right? The solicitation period. It's not enough or sufficient to go after the proxy advisors to get them to support you, or get the large institutionals to support you. I think the effort to win a proxy campaign will have to be much greater, right? Do you agree with that, Jessica?
So I do think that it will require more effort to get the message out to different constituents. And I think what is important to realize is that as we have now been in the 3rd year of the universal proxy ballot, we have seen that there were very few contests that ISS and Glass Lewis aligned on their recommendation for support, for or against a dissident or for incumbent board members. So where they do align, though, on certain director nominees, for example, that generally accounts for a 30% of the vote outcome can be kind of attributed to that joint recommendation and other institutions taking that advice in a way that accounts into their decision-making process in some way. The problem is if there is not a uniform Glass Lewis view and ISS view, there are multiple more outcomes for, given the use of the universal proxy. So I think that is what becomes more difficult, the predictability of an outcome absent a recommendation that has historically come out about 2 weeks before the vote is due. And that, could be good or bad. Maybe that gives the activist and company more time to negotiate to a resolution that is best suited for them, and ignoring any outside voices that are not their shareholders. Because at the end of the day, also ISS and Glass Lewis are not their shareholders, but their shareholders utilize their views to account for some of their own voting. So it is, I think there will be much less certainty up until vote deadlines for contested situations, absent those ISS and Glass Lewis contested situation recommendations.
So that's another trend, I think, with all of what we're talking about. I think activists as well as companies who are facing an activist, there will be, I wouldn't say significantly more pressure, but there will be more pressure. There will be more incentives to avoid an all-out proxy fight and settle any sort of contested situation early on because, because of the dispersion of votes and sort of the lack of visibility of the outcome.
Right.
Right. Just because we talked a little about the voting choices at sort of the level of the institutional investors, the Exxon retail program, voting program has received a lot of attention. So wanted to talk about this a little more, also because many companies inquire whether, they should adopt a similar program or what this is all about. Would be curious to hear what you have to say on that, John. What is your perspective? Is sort of the Exxon retail voting program, is that something that companies should just emulate, or is there what are the considerations to be taken into account?
Yeah. So without getting too deep into kind of the news, I'm assuming that a lot of the folks have been kind of tracking what has been said in the last 6 or so weeks since Exxon rolled out this new retail voting program. I think what's really important for companies to understand is what does their own company look like? The retail voting program is really interesting, and I think it's a fascinating development it's basically locking in retail shareholders to vote with management in all situations or in certain situations other than, like M&A votes or certain contested situations. That is a way potentially to lock in a sizable percentage of your voter base that is very inconsistent in voting. And Jessica can probably talk a little bit about how likely it is to get retail voters to actually vote even in a contested situation. But theoretically, if you can lock them in, that is a sizable chunk of your retail base that will vote with management consistently year over year over year. I think what's unique about Exxon, and frankly, they're probably the reason that they're probably the ones who initiated this program, is they have a significant retail base. I've heard it's somewhere around 40%, and that's probably not the case for most companies. And so what I would just recommend to companies who are considering this, and you probably are getting some questions from your board, like, is this something that we should do? It's absolutely something you should look at. However, you really need to understand your retail base because it is a very complex and potentially costly endeavor. And if you don't have a sizable retail component to go after, it might not be worth doing. I'm not saying it's not going to be worth doing, but it might not be. So just don't assume that just because we can lock in X percentage in theory year over year over year, that that's necessarily going to be the best case, because most companies, and frankly, probably a lot of companies in the energy sector, don't have that large of a retail holder base. And so it might not be worth as valuable in those instances. The other thing that we don't know yet is what the percentage or the uptake will be. We are thinking that it's probably going to be somewhat significant, but it's not clear that it's going to be anywhere close to the 40%. And so the other question that I think everybody who's waiting on the sidelines and to see how this kind of plays out is, what does the uptake look like? If it's significant, if it actually changes vote outcomes, I bet there's going to be a lot more people who follow suit next year. Absent that, I think a lot of people are doing wait and see. And that's kind of, generally what we're recommending for, unless you're a very high retail based company, that's kind of how you should probably be thinking about it right now.
Jessica, what's your view on the potential uptake?
I agree with John that it really does depend company by company, but also something to take into account is that companies will need to have a really good understanding of where their retail base is across different types of funds, because 40 Act funds are not eligible for this type of program as it currently stands, which means anything in a managed account or mutual funds are not within scope. And so it really is the individual brokerage accounts at Schwab, Fidelity, the Robinhoods, to understand who within that fragment of your retail base is eligible to participate, and that you could get their attention essentially to sign up. I do think that this program has significant advantages for a company. In one area in particular, if let's say we're in a contested situation more so than a routine, is that the votes are executed, those that have elected and opted in, they're executed when the definitive proxy is filed. So that is an instant block of votes, or block, however big it or little it may be, that a company has visibility into understanding if they need to work harder towards a settlement, or if they feel that they have a good understanding of where their passionate retail shareholders, the ones who cared enough to vote and sign up, might also allow them to predict how their broader institutional base may show up for the contest as well. So that timing, the difference of about 60 days for a company to have asymmetry information than the activist, I think is to a corporate's advantage, where they're able to engage enough of that block.
Yeah, so it gives a little bit, so companies who would adopt that type of program regain some of the visibility into outcomes, right? So it's potentially counterbalancing what we just talked about, the other trends and developments, right? Interesting.
The other thing that I would say, Sebastian, is at least in theory, if you get a sizable chunk that's basically in management's pocket, that could make you a less attractive target, at least on the margins, from an activism standpoint, because they're going to know that they have a higher hurdle to have to overcome. And so there could be a preventative aspect to it, but I wouldn't advise most companies to think about this as like a kind of like a poison pill or something like that. This is different. I mean, that's kind of I'd say a side benefit, but don't view this primarily as a defensive mechanism.
Great. Let's move on to another topic where there has been a lot of movement, and I think this was also referred to in today's news. And I think the Wall Street Journal reported this along with sort of a potential executive order targeting proxy advisors' shareholder proposals. So recall that earlier this year, the SEC came out with a legal bulletin giving companies, again, more latitude to exclude shareholder proposals. And then later this year, Chairman Atkins came out sort of with a speech, which was highly interesting and which received a lot of attention because, among other things, he suggested or indicated that companies could now exclude shareholder proposals based on state law grounds, like along the lines of if any particular state law doesn't support that particular topic to be submitted to shareholders, a company could exclude any precatory proposal under 14A8. Let's unpack this a little bit. Jessica, what's your view on this?
I think as we've kind of taken a look back this year, it's changing the tools that shareholders have available to them. We had seen an increase in the submission of shareholder proposals continue year over year over year until this year. I think something that is really interesting to dive into is that we saw about the same number of governance-related proposals still go to a vote at companies' annual meetings, and a slight increase in support from the institutional investors on governance. So continuing a trend, an upward trend for governance support, which I think really ties back to a lot of the themes that we've touched on today, is that we've seen E and S pendulum swing, but from an institutional perspective, trying to act in their best capacity on behalf of their clients from a vote perspective, those governance frameworks and structures remain core to them and what is important from an accountability perspective. I think as we had seen with this new way of handling shareholder proposals and the exclusion, we will start to see new tools emerge for shareholders to make their voice heard. And this was kind of done this year in vote no campaigns that were, loose vote no campaigns, kind of a canvassing of a shareholder base to say, vote against Director X because they omitted my shareholder proposal on what I believe to be a material issue for the company. And just kind of making their voice heard in that way. But I could also see a very likely path where those campaigns are much more formalized if shareholders feel that they are being restrained in their ability to share their voice and hold boards accountable.
John, do you think this, what sort of the legal bulletin and the overall development with sort of how Chairman Atkins views this shareholder proposal, does that sort of, can we call it the death knell for shareholder proposals?
I don't know if I'd call it the death knell. I might call it the severe injury, particularly to E&S proposals. I think to Jessica's point, I think governance proposals are, notwithstanding Chair Atkins' view on precatory proposals, that still feels like a safer place for some of these large institutions to be kind of articulating their voice. It's definitely less polarizing. I think it's a little bit easier to draw the line between action and, shareholder value, at least arguably, than maybe some of the E and the S type of proposals that were largely kind of what we were seeing on ballots over the last few years. With the change to 14M from 14L, that significantly, I think, modified the ability or appetite for some of these serial proponents to be bringing these proposals. So I'm sure a lot of the folks in this room have fielded proposals from whether the kind of environmental NGOs or even the corporate gadfly type folks. Those I think are going to dissipate in number. What is going to be interesting is, given Chair Atkins' speech where he basically said, I don't know that under, Delaware law or other state law, there's an inherent right for a precatory shareholder proposal to be voted on. That is going to potentially lead to some exclusions. I have not seen that yet, but that's going to be something to watch in this upcoming season. I would recommend that every company take a quick look at their charter and bylaws to see what is permitted within your charter and bylaws, because it was pretty clear within his remarks that, absent the company's governing documents declaring that you can do this, state law doesn't necessarily default to it. And so that's going to be, I think, a new place for us to watch. Also, the SEC may take this up in formal rulemaking and actually change the rules around 14A8. So that's just going to be a new development for us to watch. But I think, to Jessica's point, you push in one area and then there's unintended consequences in others. And so I do think that a lot of these stewardship teams, a lot of these shareholders are going to continue to voice their displeasure in different and maybe more unforeseeable ways, like, supporting a vote no campaign.
That's an interesting point, John, that you mentioned, right? That already in 2025, there has been an uptick in no vote campaigns and withhold campaigns. I mean, there are different flavors of a withhold campaign. There's sort of on the one end of the spectrum, you have sort of the single press release of an activist saying, I don't like what you're doing, and I encourage everyone to vote against sort of whatever the company is proposing. And on the other end of the spectrum, you can have a no vote withhold campaign that goes the full way with a full proxy statement. And then I think the middle ground, somewhere in the middle, is the so-called exempt solicitation, which allows you to put out more press releases, letters, et cetera, so long as you don't solicit proxies. That, in fact, can put a lot of pressure on a company, even without submitting a formal shareholder proposal. It creates a lot of noise, a lot of distraction. It gets the attention not only of the institutional investors from a large shareholder base, and if it is being done the right way, that could change outcomes too. What do you think, Jessica?
I agree. I think that, as you say, they come in many different flavors, but it really will kind of span, how institutional investors are looking at certain items, how an activist might be making their case. And sometimes I think the other element of a vote no campaign is that sometimes the perception is, this is the cheapest way to run a proxy contest. But it's always interesting to me to learn about the behind the scenes as as someone previously in a stewardship seat, to ask about the interaction between an activist and a company where there is kind of a more contested situation, to figure out what the dynamic was, because I think that gives a lot of color into the governance or the willingness of a company to hear outside shareholder views, and also kind of the timing of those negotiations in line with nomination windows that may have come or gone. So that's another kind of interesting component of the vote no and withhold campaigns.
And the other thing that I think vote no campaigns potentially bring up, and I think this kind of weaves into the rise of the universal proxy card. I think good disclosure is something that we all, as lawyers and corporate secretaries, should endeavor. You have an opportunity to tell your story. You might not be able to get the meetings that you once got and were able to have kind of that two-way dialogue, going back to the point that we talked about earlier. You still have the ability to communicate with your shareholders. And this is where I think that a vote no campaign could get really interesting, because there's a lot of, I'd hate to call it dead weight on boards, but there's at least the perception of it, because there's a lot of bad disclosure out there as to why somebody's on a board, why the board is fit for purpose, why has X director been on the board for 14 years or 17 years or whatever. You have the opportunity, and I think that, if you want a practical tip as a corporate secretary, is think about better ways to disclose that director's purpose on the board, because I think that you have the unique ability to make them less vulnerable in some of these vote no campaigns and some of these universal proxy card situations. And I think that the people who are voting the proxies will appreciate, and also you want to kind of lead them to a yes, as opposed to lead them to they did a pretty poor job. Yeah. So this dissidence.
I was going to say, right, I mean, the preparation for a vote no or withhold campaign, if sort of you expect something to come up, where someone is attacking your slate of nominees, is make sure that your nominees, that your board actually satisfies the requirements, and that they have the industry expertise, the sophistication in accounting matters, whatever is required, right, as you say, and then plus disclose it appropriately. Don't just use boilerplate language in the biographies, but sort of make sure that everyone understands how sophisticated this or that director is, what expertise they bring, and what they contribute to the board.
One of the things that this discussion is bringing up for me is I just think that companies should be a little bit more thoughtful about the fact that I think activism, and maybe Sebastian, you have a little bit more data on this, but activism is going to be on the rise, and I do think that companies should view each of their directors as vulnerable. And it's just a different world that we're in now. It's a much more fragmented world. It is a much more complicated world. However, I do think that the activists are going to continue to have their theses, whether that's an operational thesis or an M&A thesis. And so I'd be curious, like what you're seeing on that front.
That's right. I mean, you're preempting where I was going next, sort of the outlook for 2026, what we think the big themes are, and maybe I kick it off. I do believe that with the call it the resurgence of the M&A markets in 2025, we'll see more of that going into 2026. Not only do I believe that we will see a more robust M&A market, but I believe that we will see a lot of M&A will be driven by activists, either behind the scenes or openly. I think that generally activists or investors generally, I don't think they place as much weight on sort of the return they're getting by improved operations than by a company sort of executing on a transformative transaction. And a transformative transaction can take many, forms or shapes. One would be an outright sale. It could also be what we have seen over the summer, right, is the so-called breakup of a conglomerate, that companies realize that they have underperforming segments, which overall detract from the overall value of the well-performing segments. And so they may have to look at their portfolio and think about whether it makes sense to continue, operating all those segments, or whether it makes sense to divest that segment or even spin it off. So I do believe that we'll see more of that. And what are the other themes that you expect to see next season, Jessica?
I think that within these contests, director skills will be increasingly important. And as you say, it will go along with the thesis, whatever it is. But we've increasingly seen activists put up operators, and particularly recent operators, as nominees on their slates, and be much more critical and thoughtful about gathering a group of people together, often larger slates than they have had in the past because of the variable outcomes now that we have the universal proxy, but being sure that investors are aware that, Director X brings the expertise that directly fits in with this strategic improvement, or Director Y will add to, this element.
You bring up a great point. I always, when people talk about activism, I think people still use a very traditional vocabulary of attack and defense. I think that's almost antiquated. I think these days we no longer talk about activism, but shareholder engagement, and that can be in a more negotiated, friendly way, or that could be in a more contested way. But overall, I think everyone has to recognize that shareholder engagement is not just a seasonal topic, but it's something that even you mentioned it, an off-season topic. I think it's a year-round, all-year topic. And to your point, Jessica, I've seen many activists who propose or submit a slate of directors where you say, oh, wow, that's a great candidate. Or we have had clients that look at an activist proposal and say, let's interview this person. This could be a great addition to our board. So I think companies should be open-minded and not immediately sort of, circle the wagons the moment someone emerges, but approach it sort of, proactively and engage proactively.
The other thing I would say on that point, and I think this is probably a development that's been building over the last probably decade plus, is to the point Sebastian was making about how we shouldn't think of the kind of an old way of activism. I think the candidate quality has increased significantly. The kind of stain of being associated with an activist slate is gone, and sometimes the blood that they're bringing to the board offerings can be very interesting. And I think that institutional investors in particular are more amenable to some of those theses because they're like, oh, this is a CEO in that sector, or this person has actually done the turnaround that you've been saying you want to do for the last 5 years. He's actually done it. And I think that there's a little bit more of an appreciation for fresh ideas. And I think, given the regulatory landscape is changing and that, potentially, antitrust is a little bit less of a focus for this administration, I think that other theses around breakups and sales of company, those things are going to be rising in prominence in the coming years. And that's where I think also having interesting director candidates and good disclosure, if you're on the company side, is really important because that's your opportunity to tell the story that you might not be able to tell verbally anymore.
Yeah, Jessica, anything else you want to add on the expectation for the next proxy season?
Just one thing that John said that I think is worth noting from a trend perspective too, is that as we've seen these director slates be built out, we've also seen fund professionals not nominate themselves as much. Sometimes they will still maintain board seats through a settlement. But I think that understanding of how institutional investors, how proxy advisors have looked at independence of a board has really come into play for when those activists are selecting nominees, in that, oftentimes another fund professional, a PM from the activist running the campaign, isn't seen as independent. And that idea of an independent voice along with the skills that are needed has become increasingly important. But for the rest of this year and into 26, I think, as we've mentioned here, taking a look at your disclosures, being critical about the skills that you have on the board, where are there gaps, or where, we are in a very fast moving world as AI continues to evolve how companies operate. Is the board fit for purpose in that regard? Or, how are you overseeing components of the business that have changed at a pace that is just so much more dramatic than they have in the past?
And the same way, I think, you see a fragmented investor base, a dispersion of votes, the lack of visibility of outcomes. I think companies also need to be prepared that you're no longer dealing with just the very established activists, but you also see many, many newcomers. They don't have an established playbook. They don't necessarily have the 10-year or 15-year track record. You see a lot of motivated funds or investors making inroads. And I think that highlights, in my view, and underscores the importance for companies to focus on the skill sets of their directors, disclosures, making sure they have their strategy, that they review the strategy with their boards regularly and periodically, so that they're well prepared and that they are able to communicate that to the investing public.
Yeah, I think that companies should really try to control the controllables as much as they can. And so that's disclosure for one. I mean, that's something that we all control in this room, frankly. But also thinking, back to the point that I made earlier, I think there's going to be a continued retrenchment to the safe space of G. And so get your house in order as much as you can on a governance standpoint. Now, there's tension because sometimes good governance is probably bad shareholder defense. Like having a classified board might be very useful, but it's probably disfavored. And so you're going to have to balance those considerations. But to the kind of the activism thesis, there are things that are just really hard to control, like share price and performance. Like, of course, we all want to perform. And I think that the best prophylactic is good performance. You're probably not going to get a serious shareholder activist trying to do something if you're doing well. When you start kind of struggling, then you can control the controllables. And so that's where good disclosure comes in. That's where good engagement comes in. That's where understanding how to share your board story a little bit better, I think is potentially useful because, like I said, everybody is vulnerable now. And so we just need to understand this much more complex, much more fragmented, much more messy world that we live in.
So we're in the middle of our takeaways to wrap up our session. Do you want to go through your big takeaways? What is it that you would like our audience to take away from today's session, Jessica?
I think we've covered them in a variety of different ways here, but I think one that we'll need to keep an eye on in particular is just understanding that you will need to cater your message slightly to different stewardship teams, different portfolio managers who have a different view than perhaps the passive stewardship team that you've traditionally spoken with, given that some of the big index funds have split their teams. So be aware of that and the messaging in addition to all of the other ways in which your shared ownership is getting broken up.
John, I think you've already sort of touched upon some of your key takeaways. Is there anything else you want to convey?
No, I mean, I think if you're going to take one thing away from what I'm saying is this year and probably coming years, opaque is going to be the magic word. It's going to be very unclear how things are going. So, try to control as much as you can about the narrative because the folks who are looking at your disclosures and distilling those disclosures and their vote outcomes, that landscape has changed dramatically, even within the last year. And so just know that you can do what you can. And so that's where I think good disclosure is going to come into play. The other thing, maybe this is a little bit more niche, but on the retail voting program that I talked about that Exxon has rolled out, I think that's a really interesting development, but I don't know that it's for every company. And so I would watch that if I were you, understand the size of your retail base and see what that uptake looks like. Because before you pull the trigger, before you tell your board we're going to do this, you should probably make sure you understand if it's worth doing. So that's just something that I would, take back as you probably are already fielding questions from your board members.
Yeah, I think from my perspective, and I think this always falls a little bit through the cracks, but I think it's really critically important, and I mentioned it before, which is that every company should have a strategic plan plus sort of a financial forecast that they regularly review with their board every year at least. Because that's ultimately the benchmark against which you compare any strategic alternative, be it a spin-off, a sale, a joint venture, whatever affects the company. So if you are, as I said before, I think M&A markets continue to heat up. When you're faced with an unsolicited acquisition proposal, or when an activist is pushing for some form of transformation, either a spin-off or a divestiture, the first thing that you need to do as a board is you need to, huddle together with your advisors, and you have to have your strategic plan ready to compare that proposal and the financial implications. The other aspect to that is, one is to have a strategic plan and a financial forecast. The other piece is that you are able to, or not that you're able, but that you're effectively communicate that to the investing public. Sometimes the best defense against any sort of, and I'm using the antiquated word attack, is by sort of having it out there, what you're doing, what you intend to do over the next 5 to 7 years. So I think that's my advice to companies. And I think we're open to take any other questions, but I don't see any. So either we've covered everything, or or maybe questions will come later. But otherwise, thank you both very, very much. This was very highly interesting, and I hope that our audience feels the same way.
Thank you.
Thank you.
Good afternoon, everyone, and thank you for joining us for the participatory ethics portion of your CLE journey today. Welcome. My name is Catherine Frank. I am a capital markets and securities partner in our Dallas office. I focus on corporate governance, public company representation, and capital raising. And I'll let my co-panelists introduce themselves.
Yeah, hi, I'm Jeff Johnston. I'm in Vinny's Houston office, and my practice focuses on government and internal investigations, including SEC investigations. I also do shareholder litigation and cybersecurity. Zach?
Hi, my name is Zach Terwilliger. I'm a partner in our DC office. Been at V&E for about 5 years, and prior to that, I spent almost my entire career in government at the Department of Justice, briefly on Capitol Hill on the Judiciary Committee, and then a year and a half at Maine Justice, and finished up as what we're going to talk about in a minute, the U.S. Attorney for the Eastern District of Virginia. So great to be here with all of you in person in Houston and those of you tuning in. Great. Well, I get to kick things off. We're going to shake things up a little bit now. We're going to talk a little bit about criminal enforcement, white collar enforcement. And what I'd like to do is talk you through just a couple enforcement mechanisms that have been making a lot of, there's been a lot in the news about these. So let me start there. As somebody who's from Washington, D.C. and has lived through multiple presidential transitions and, watches the people fly in from Texas when it was the Bush administration, and then Chicago during the Obama administration, and then and the like, you obviously get different priorities from different departments of justice, SEC enforcers, et cetera. I'm sure those of you, unless you've been completely tuned out of the news or social media, are aware there's a lot happening in Washington. We not only have a government shutdown, we've got a number of high-profile cases that are moving through the Department of Justice, and we've got some priorities. One thing I think is really important, anytime someone's speaking to you about these priorities, we talk about the DOJ or we talk about the White House. Those are buildings or institutions, but what we're really talking about are offices and, frankly, some of the people who occupy those offices. So what you see up here is an org chart for the Department of Justice. And at the top, you can see the Attorney General. That's Pam Bondi, and the Deputy Attorney General, Todd Blanche. What I've circled here is the Federal Bureau of Investigation, the U.S. Attorney's offices, and the Criminal Division. In general, those are going to be the units that when we're talking about white collar enforcement and corporate enforcement, that's what we're talking about. For those who aren't aware, the U.S. Attorney's offices are out in the field. And I've got a slide in just a minute that'll show you where those U.S. Attorney's offices are located. But you've got 94 U.S. Attorney's offices across the country that correspond to the judicial districts. And that's what we call the field. Maine Department of Justice, generally we're talking about the Criminal Division. And that's where a lot of your specialists are. So back during the heyday of the Foreign Corrupt Practices Act, in the Criminal Division, there's actually an FCPA unit. There's also a Public Integrity unit. That was the unit that brought all the cases against elected officials and the like. There's also the Money Laundering and Asset Recovery unit, MLARS. And so that's where that specialization is coming. And then there's a lot of investigators out there, whether that be the IRS, criminal investigators, whether that be the Office of Inspector General. But when it comes to the Department of Justice and it comes to corporate enforcement, it's generally the FBI. And so that's why they're circled. Next slide, please. Okay. These are the U.S. Attorney's offices across the country. You can see in Texas, it's a little bit of an odd map there with the Northern District of Texas extending, from Dallas all the way up to the Panhandle, the Eastern District, which does seem to make sense. And then you have the Western District that, spans quite a bit. And then the Southern District where we are today. My old office is that VAE, Virginia Eastern District. The reason I bring this up is if you are in-house or you're a board member and you get a subpoena it matters where that comes from. Not all U.S. attorneys' offices are created equal, and it can tell you a lot about the investigation, about where it's coming from. So when you get process from a U.S. attorney's office, whether that be a civil investigative demand from a civil AUSA in a False Claims Act case, or a grand jury subpoena, or God forbid, a search warrant, at your corporate headquarters, it matters where it's coming from. And these are the field offices, and we'll talk a little bit more about that in a second. Next slide, please. Okay, so typically when we give talks like this in past administrations, we're reading tea leaves, we're looking at confirmation hearings, we're looking at speeches that have been given by individuals in the Justice Department to tell us what are the priorities. If you are a corporate entity, what is it that you need to be worried about the Department of Justice focusing on? Well, in this administration, in May, the acting Attorney General of the Criminal Division, Matt Gagliotti, put out a memo and basically said, this is how we're going to focus on corporate enforcement in this environment, and these are going to be our priorities. Incredibly, incredibly helpful to have that laid out in a memo. And you can see at the top of the slide here, fairness, focus, and efficiency. Pretty remarkable for Department of Justice to put that out. And where that comes from is as follows. There were a lot of people during the prior administration who felt like some of these white-collar enforcement actions would languish. They would take a long time. You would, be asked for documents, and then you really would have no idea what was happening. And as all of you know who are out there in corporate America, if you end up with a corporate investigation, it can cause a tremendous amount of business disruption. It could be incredibly expensive, incredibly stressful. If you're a public company and you're having to disclose it in your quarterly or annual disclosures, it can affect your stock price. What this memo basically lays out is we understand that as a Department of Justice. So the enforcers saying we understand that when we issue a subpoena, it can have these massive collateral consequences. So what we're going to do is we are going to be focused on certain areas. We are going to approach this with fairness. And if it's just one or two bad apples in your organization, that's who should be prosecuted, not your organization. We're not going to go corporate scalp hunting. And we're going to be efficient in what we do. We're not going to boil the ocean. Not everything is going to be a RICO case. And we don't need to bring 70 count cases if we can bring 3 count cases. If I were a chief compliance officer, a board member, a CEO, someone in the legal suite, I would be really heartened by this. I think this is a really important message from the Department of Justice. You all, I'm sure, are aware that the department's current priorities of immigration, violent crime, the southwest border, tariffs, what that means is a lot of the energy is being focused in those areas. And one of the areas it's not being focused in is corporate enforcement and white collar crime, the way it has in past administrations. So it is, if you're a corporation, I think you can take a little bit of an exhale and do a really nice, we're going to talk about this in a minute, a nice internal assessment of where your compliance needs to come up, what you need to do. Because right now, this is a department that has frankly not allocated the resources to focus on corporate enforcement the way we've seen previously. One of the other things that I think is important to note is this Department of Justice actually, via this memo, put out what its priority areas are. And so we can go to the next slide. So really helpful when the department says, these are our white collar priorities. You're not left there guessing. And if you're looking at this list, there's probably some that many in this room could not imagine them applying to your day-to-day, like material support of a foreign terrorist organization, facilitating cartels, terrorists, and hostile nations. Those are things that are absolutely a priority for this Department of Justice, but those are things that are being done via the National Security Division, via the Department of Homeland Security, via the CIA, and via violent crime prosecutors and cartel specialists. And look, in the first administration, these were priorities as well. Absolutely. I mean, many of you may remember the big crackdown on the transnational organized crime that was coming from South and Central America in the first administration. The difference was, in the first Trump administration, white collar wasn't a priority, but it wasn't de-emphasized and resources weren't moved from one area to the next. In this administration, we've seen FBI agents being pulled on temporary details to focus on immigration. We've seen prosecutors being reassigned to focus on these areas. So what does this list mean to you? Well, the way I interpret this is if you're doing any business with the federal government, whether as a healthcare entity where you're seeking reimbursement from Medicare, Medicaid, or TRICARE, certainly if you're in the DoD space as a contractor, you absolutely do need to perk up and pay attention. And that is something that we spent a lot of time where I'm from in Northern Virginia, a huge defense industrial complex there outside of the Pentagon in Crystal City and out near Dulles Airport. So absolutely have to focus there. The other piece I would say is if you are a subcontractor or you're someone who is interacting with this government, as we're seeing now, the government's making investments in private companies. These are things you really, really need to pay attention to because this concept of waste, fraud, and abuse, that's basically what the False Claims Act is used to do, is to ferret out waste, fraud, and abuse. We really saw that with the Department of Government Efficiency and DOJ and everything like was going on in Washington. This administration is hyper-focused on ferreting out waste, fraud, and abuse. And so if you're doing anything with the government or you have a contract with the government or a lease with the government, absolutely everything is being scrutinized and you need to make sure you're doing your due diligence ahead of time and you're really focused on it. Aside from that, as I look at this, obviously, if you're importing anything, you know better than I do what this environment has been like. But one of the things we do see a lot of emphasis on is, are people engaging in, are they violating anti-dumping rules? Or there was actually a case in Dallas from this administration where someone said something was one substance for a countertop when it was really another to reduce tariffs. So I would absolutely say that's another area of emphasis that you may want to focus on. And then if you're at all involved in the transfer of money, whether you're a money transfer business or you theoretically could be used even unwittingly to launder money. I represented a company last year that was, accused of somehow facilitating the transfer of money from point A to point B through a various system, and it's not one you necessarily would think of. And so if your business is involved at all in where money is coming in from one place and then an item or object is going to another place, making sure your anti-money laundering provisions are in place because absolutely the government is following the money when it comes to cartels and transnational organized crime. Next slide. Okay, I mentioned this a moment ago, but I hear this from a lot of clients. Well, Zach, you've told us that this is not necessarily a time of robust enforcement. This is not a time where, because we took a government official to a dinner and we disclosed it, that we're going to have an FCPA violation. So what about compliance? One thing I've learned over my 13 years with the Department of Justice and now 5 years in private practice, one of the best ways you can inoculate yourself as a company is with robust compliance. And it's not just a nice to have, it's an absolutely need to have for a couple reasons. One is, should you get in trouble? Should you just be investigated? It's going to be one of the first things that the prosecutors want to know about is, how'd you find out about this? If you didn't know about it, where was your compliance plan? And then on the back end, every corporate resolution I've ever negotiated with the government all revolves around what's the status of your compliance plan. And importantly, and this probably is obvious, but what the government wants to see is a compliance plan that isn't static. They don't want to see a compliance plan that is based on your 2015 risk profile. How have things changed and how are you adapting to it? AI can be a tool, it can also be a risk. And so one of the things that I think now is a great time to do as a chief compliance officer, as a board, is look and see, where are we on cybersecurity? This is one of Jeff's areas. Where are we if we were to suffer a ransomware attack? Where are we on two-factor authentication? Where are we on our gifts and hospitality policy? Because I'll tell you what, a lot of these federal offenses have 5-year statute of limitations, and you better believe white-collar enforcement's going to come back around at some point. And when it does, the government's absolutely going to look and say, well, what were you doing? Were you investing in compliance? Were you focused on good corporate governance? Or, did you sort of, put your feet up and say, well, we don't need to worry about it this time? So I do think now is a time to dig into compliance. I've handled crises for companies and I handled crises in the government. It's really hard to build the plane and keep flying it. So now is a great time to dig in and dust off those policies and look at them and look at your risks when you're not being investigated. I would say too, we don't know what the future may bring. It's a time of immense upheaval, politically, technologically, potentially financially, if you believe, what you read, that, we're coming for a market turn. If you can put yourself in a position now where no matter what happens down the line, you can say, we are not only a company that's focused on compliance, we invested in it and we modernized it, it's going to be worth its weight in gold should you have a problem. And if you do it right, you're going to get a heads up and it's going to hit a tripwire before, you have a whistleblower or someone else. Ideally, the corporate compliance plan is such that if you have a problem, you're going to know about it first. Next slide. Okay, in the couple minutes that I've got left before I turn this over to my colleagues, I thought it might be important or might be helpful to do a little bit of a case study. It's also participatory ethics, so I want to make sure we satisfy that. So let me give you a little bit of a scenario. So Acme HHC, which is a home health care company, provides home health care for individuals, receives a complaint from an employee. So it's not an anonymous tip, it's an actual employee who gives a complaint. That they overheard an alleged price fixing conversation between their regional supervisor and a competitor at HHR 2025, Home Healthcare Rendezvous, always in Las Vegas. And for those of you who are in-house, this is an issue when people go to these trade shows and what happens and what they're talking about. I can't tell you the number of investigations I've been involved in, both in the government and now in private practice for things that happen at these trade shows. The employee is very concerned, and it seems like they may have spoken to a lawyer, at least used AI. You laugh, but this is a thing now. Everybody's got a lawyer in a can. Go to ChatGPT and figure these things out. And so what do you do next as the chief compliance officer? So what I would suggest is, look, you're not going to pick up the bat phone and call, outside counsel at V&E, maybe, if you just get a complaint. What you're going to do is do a little bit of investigating first. So the chief compliance officer performs a very targeted investigation to determine, look, was this supervisor even at HHR, and what's the supervisor's region? Let's do a little bit of internal digging to just see, is this a situation where, somebody is making something out of a whole cloth? Turns out it's checking out. There's some there's some smoke. So I think one of the questions you have is, do you bring in outside counsel? Well, you're sitting in this beautiful Vincent and Elkins conference room. So the answer is no, I'm just kidding. It really is a question. And I will be the first to say that outside counsel isn't always needed. And it may be something that, frankly, can be better handled in-house. Where I have seen bringing in outside counsel in a situation like this to be very, very useful is as follows. If you are in a situation where you think you may have a potential whistleblower on your hands, this is not someone who just heard something and is doing their job and reporting it, but is giving you this vibe that they've got a real concern, or that this is not something that is just going to go away. Or you actually may have a price fixing conspiracy with one of your competitors that could cause you problems for the next 3 to 5 years. You do want to bring in outside counsel for a couple reasons. We can go to the next slide. So outside counsel is retained for these reasons: independence and objectivity. Especially, I know we've got a lot of public company attendees here and on Zoom. I will say that when I'm dealing with an internal investigation and I've got to deal with the outside auditors, in my experience, they really want to see someone who is come in and is independent and objective. And a lot of times they want to see folks who've done lots of these investigations. And a lot of times these people are former FBI or former IRSCI or former whatever. And it has been really, really helpful to be able to talk to them about what we found and what we haven't. It also sends a very serious message. It shows the potential whistleblower or the complainant that you're taking it very seriously. And it sends a message across the organization that, look, we're going to take this stuff very seriously. We're going to investigate this. And if ultimately nothing comes of it, nothing comes of it, but we took it seriously. A regulator down the line, were this to come anywhere, would say, well, why didn't you call outside counsel? You thought this may be an issue of price fixing. You really thought you were in the best position to handle that. That's another thing. It also is really important if you think this employee is talking to a lawyer, so that way you can go lawyer to lawyer. Okay, so what do you do? What's the plan? You got to preserve documents. And I was actually just having this conversation with a client yesterday. I'm a big fan of not boiling the ocean unless you need to, but you want to preserve documents at least. Doesn't mean you need to collect them all, but you want to preserve them. You want to do a collection of limited PST files, emails around this particular incident. You want to look at pricing for the region. Did pricing even change? What is pricing in this region where this supervisor is? Is this competitor a real competitor? You want to look and see, look, are people trained on this? Are they told that, there would be a really bad idea to talk to your competitors about pricing and wages and those sorts of things? You want to look at your code of conduct, even if we don't have a crime here, did this person, violate anything? And then you want to do a set of targeted interviews. You want to talk to some other attendees at the conference. You want to talk to back office support. You certainly need to talk to the complainant, make sure that person feels heard. And then you're going to interview the supervisor. And you're going to do that as outside counsel on behalf of the company. So you're going to issue an upjohn warning and you're going to engage and find fact. And that is going to inform the advice then that you give the company. Next slide. Okay. So you get done with your internal investigation and you have a meeting with the chief compliance officer and the general counsel. Well, like many of these things, it's not black and white. What you're able to establish through your interviews, your emails, et cetera, is the conversation appears to have occurred between the competitor and the supervisor at HHR in Las Vegas, but no action was taken, either directly or even steps that would lead to a path. It appears this was an aspirational conversation that had more to do with what they wish they could do as well as a good dose of alcohol. So everyone's back at the bar saying, man, wouldn't it be great if, I could get my numbers up if we could just agree that home health care workers, we're going to get paid, $13 an hour instead of 15, that would increase our margin, et cetera. So what do you do in that situation? I mean, I don't think you have an antitrust conspiracy. I think what you have is two people not being careful, but you need to do something. So get your outside counsel. You want to give specific counseling to that supervisor. Maybe you do a performance improvement plan with HR. You want to make sure you have a specific code of conduct for conferences and events. And then maybe you create a control. I mean, in this day of data crunching, why not create a little control to see, if there's a rate change that happens right after one of these conferences. Maybe that should be something that you have a control for, or something's off cycle or it's just an outlier. So that's a little bit of the case study 101. Happy to stick around after as I turn this over to my co-panelists. But I think the takeaway, if you don't remember anything else, I would say this is a time to look at compliance, look at these risks that we've talked about, and to the extent you have any questions or things come up, now is a great time to run those to ground because you have a Department of Justice that is looking at white collar and corporate enforcement in a way where you really can get things resolved versus if you wait, till the next administration or just, bury it, you may be back in those situations of multi-year investigations.
Awesome. Well, thank you, Zach. You've given us great background and practical advice, and I'm hoping we can pass it over now to Jeff to talk a little bit more about the Securities and Exchange Commission and how it's changed or is changing and its enforcement arm.
Sure, happy to do that, and thanks, Zach. I think to cut to the chase, what you're going to hear from me is very significant, very similar to what Zach said. On the SEC enforcement side, dramatically down. We're seeing far, far fewer enforcement actions and less resources. And so let me talk about sort of how we got there. New leadership. Chairman Paul Atkins is an SEC veteran, very well regarded, started his career as a corporate lawyer in New York, served on the staff of two SEC chairmen, and then was appointed to the commission by George W. Bush from 2002 to 2008. He has appointed as his director of enforcement Judge Margaret Ryan. Judge Ryan was a senior judge on the U.S. Court of Appeals for the Armed Forces. Before that, she was in private practice at Wiley Rain and Bartlett Beck. Before that, she clerked for Supreme Court Justice Clarence Thomas. And in appointing her, Chairman Atkins said, Judge Ryan will lead the division guided by Congress's original intent, enforcing the securities laws, particularly as they relate to fraud and manipulation. So the message they're sending is back to basics. Both of these picks are viewed as pretty down the middle mainstream picks, but what we've seen is that hasn't really translated into enforcement, really quite the opposite.
We know there have been layoffs across the government. Have there been layoffs at the SEC, and what does that mean for enforcement going
Yeah,
forward?
no, that's a great question. Headcount is down pretty significantly at the SEC and in particular in enforcement. So the SEC didn't do broad layoffs. So what they did was a buyout program where they would pay you money to go away. And they got a lot of people to take them up on that. So headcount, public reports, and this was a couple of months old now, that headcount was down 15% across the SEC staff. But if you look at the numbers, the biggest bulk of those are in enforcement. And they don't tell us whether, that's the back office staff or the enforcement attorneys, but it's probably a little of both. And so I think naturally you would expect that to lead to reduced enforcement. Now, Chairman Atkins, when he's out on the stump, is saying he's going to fill those vacancies, but that doesn't appear to be happening. And what we're seeing in reality is significantly reduced enforcement. So what they're doing is they dropped a bunch of cases. They had a bunch of existing cases that they just dismissed. Controls and registration cases where there was no significant fraud. A lot of those cases get settled as negligence cases. Those cases were dismissed. Disclosure control cases, crypto cases, a ton of crypto cases were dropped, and that was a particular focus of the commissioners themselves, who under the prior administration, the Republican commissioners had been criticizing the enforcement actions in crypto in particular as sort of regulation through enforcement as opposed to regulation through rulemaking. And so what they're saying is they're going to go back to rulemaking. On the cyber side, they say that they're not going to, well, on the cyber side in 2016, so the prior Trump administration, their approach there was they're not going to second guess good faith judgment about cyber incidents. So they're not going to second guess your cybersecurity prior to the incident, and they're not going to second guess disclosures you make as you're going through and completing an incident. Then the last administration, the Biden administration, we saw really the second guessing came back, and there was some real second guessing, and the SolarWinds case is a big example of that. Of not only did they second guess SolarWinds disclosures about the breach, but went back and looked at everything they ever said about cybersecurity and sort of determined whether they were 100% accurate. The court dismissed most of those claims. They've announced a settlement. They haven't told us what the settlement is. And what we're seeing from this new administration is we think they're going to back off of these sort of second guessing on the cybersecurity cases. That I think is probably going to show a more of a hands-off approach. So what are they focused on? Well, as I said earlier, it's sort of back to basics. They say they're going to go with traditional cases. So what's a traditional securities enforcement case? Well, insider trading. We're going to spend some time on that later. And we have seen, to the extent they're bringing cases, they're bringing insider trading cases. Accounting and disclosure fraud, so 10Ks, 10Qs, 8Ks, that kind of thing. Retail investor fraud, so that's going to be the sort of market manipulation, the pump and dump schemes, and we see them bringing those, but those are more sort of the penny stock kind of cases where it's just really egregious fraud, either in the offering or in the the touting of the company. And then they've said, and Zach touched on this earlier on the DOJ side, is a focus on individual accountability, right? So commissioners have said for years that if you fine a company, that fine, that harm gets passed on to the shareholders who have already been harmed by the fraud. So sometimes it doesn't make a lot of sense to fine the company. But if you find the individuals, the executives who engaged in the conduct, well, it's public policy and the policy of the SEC that those fines cannot be paid by the company and they cannot be paid by insurance. And so the individuals pay those fines, and that's not passed on to the shareholders. And so that return to, if it happens, individual accountability will be important. The chairman was quoted as saying, investor protection is the cornerstone of our mission, to hold accountable those who lie, cheat, and steal. So what's the message? No more lying, cheating, and stealing. So how are they doing this? They've sort of restructured. There's new task force. So they've sort of taken what they were doing on cyber and crypto and combined it. The Cyber and Emerging Technologies Unit is going to focus on fraudulent disclosures related to cyber incidents. So they're not going to second guess you, but they're not going to allow fraud to get away with it. They're looking at real fraud on crypto and blockchain technology while they're at the same time in other divisions working on regulations for crypto. They're looking at hacking efforts where the bad guys are trying to get insider information so they can trade on that information. And then they're looking at artificial intelligence, both from a company's, any company now that says they're doing something with data centers, their stock price doubles, right? So they're looking for that kind of thing where companies are using the word artificial intelligence, not because they're really using it, but just to sort of boost their stock price. And then the flip side of that is they know that AI is going to be used to commit fraud, and they're looking for ways to actively combat that. They've also put together a cross-border task force unit, replacing the FCPA unit, strengthening their efforts to combat cross-border cross-border fraud that harms U.S. investors. They say initially they're focusing on U.S. law violations by foreign-based companies. So there are lots of foreign companies that are listed in the U.S. and they're looking for fraud in those circumstances. And what they're seeing there is more the sort of bread and butter market manipulation and pump and dump type schemes we mentioned earlier. They've also said here, this goes hand in hand with the focus on individuals. They're going to focus on the gatekeepers who allow this fraud to happen or don't prevent the fraud from happening. And there you're talking about the auditors and the underwriters who are in the chain of what's happening. And they've announced that they're in particular going to focus on China here. So there was also, when we think about what we might be seeing going forward, there was also a procedural move that was interesting and I think bodes for reduced enforcement action. The commission under the prior administration, the director of enforcement could issue a formal order investigation. And why is that important? The staff cannot issue a subpoena unless they have a formal order of investigation. And once they have that, they have subpoena power. The commission has taken that power back. And so now if the staff wants to issue a subpoena or have subpoena power, they don't just go to the director of enforcement, they have to go to the actual commission itself. And that's not easy. You just don't sort of send them an email. You have to send a formal position paper laying out the facts and why you think something needs to be investigated and why you think there might be securities fraud here. The 5 commissioners have to look at that and sign off on it before you can get subpoena power. And so what that means is you're likely to see, and we are seeing a little bit of this, the SEC will just reach out with what they call an informal information request, a voluntary information request. Hey, would you mind just giving us these documents and letting us talk to your employees? And the conversation I always have with a client on the front end is, well, if it's voluntary, can't we just tell them no? And sure, you can tell them no, but then they're going to go write that memo and go get the subpoena, and they're not going to be happy with you. And the beauty of a voluntary information request is you're doing it voluntarily. And so you can sort of stake out the scope in which you're going to comply. Now, you need to tell the SEC, this is what you've asked for. Here's what we're giving you, and here's how we're giving it to you. But they're very more accepting of that than a circumstance where there's a subpoena, and they say, well, that's very nice of you, but that doesn't comply with our subpoena. Please go back and give us what we asked for. You also, the SEC is really big on cooperation and investigations, and giving them stuff when you don't have to goes a long way if they eventually find a violation.
So the SEC put out cybersecurity disclosure rules a couple years ago, and we have talked about them for years in this conference. We've had a couple of 10K seasons. Has there been any enforcement in that area, or do we have any new guidance on cyber that we should be taking into account for next year?
So we haven't seen any enforcement in 2025, and particularly not any sort of coming out of the new rules. What we've seen, and we frankly didn't see any enforcement of the new rules in 2024. So I think that's sort of, they're not micromanaging that process. What we do see, and the guidance that we've got, is the comment letter cycle has started, and the Corp Fin has been issuing comment letters on the 1C cybersecurity disclosures. And just to sort of table set here, in 2023, the SEC issued its final rules on cybersecurity. 2 main components. Companies are required to discuss their risk management strategy and governance related to cybersecurity in item 1C in the 10K. And then when they have a material cybersecurity incident, they're required to make a disclosure on an 8K within 4 business days of determining that it was material. So what we're seeing in the comment letters is really on the 10K disclosures, not the 8K incident disclosures. And so the themes that have emerged from that, and there's I don't know, a dozen or so letters, couple of themes emerge. The rules say you're supposed to disclose which management positions and committees are responsible for assessing the risk and handling cybersecurity. And what we've seen is if you say our CISO is responsible, period, they want to know who's your CISO and what is that CISO's expertise. But if you say further, and we saw a bunch of these, and companies like to sort of say, we're on top of this. And so sometimes what you see is the CISO in coordination with the CFO and the COO and the IT director, an internal audit, and the general counsel oversee this. But then you just talk about your CISO's credentials. They're going to come back and say, well, tell me about all those other people. I want to know what their credentials are and why do they have the expertise to be dealing with cybersecurity. And so, and that's an instance where I think they're trying to encourage more disclosure. That's probably going to convince companies to give less disclosure in that incident. And they don't want, like, we have a combined 42 years of experience here. They don't want you describing it in the aggregate. They want you talking about each individual person. So they want more details. They've also focused a lot on, so there's questions about how you use third parties in your cybersecurity. And there's a number of comment letters where the companies have said, we don't use third parties in our cybersecurity. You go 2 paragraphs down and they say, CISO in connection with our third party vendors does this. And they'll say, but that's inconsistent. You said you didn't use third parties. Now you're saying you use third parties. Which is it? So you just have to be consistent on that. On the enforcement side, so there has been cybersecurity enforcement, not in 2025. We're not seeing hardly any enforcement in 2025. But in 2024, we saw enforcement that really has been consistent over the years. Some themes that I don't know whether they'll continue, but the themes that we've seen in the past are, and this goes back 10 years when they went after Yahoo after a breach, you can't describe something, in your risk factors, you can't describe something as hypotheticals. This may happen. Our network may be breached when it has already happened. The SEC's view is if you say something may happen, implicit in that is it has not happened. And that means if it has happened, you're lying. So if something has happened, you need to say, we have had cybersecurity incidents in the past that have not had a material impact on our business, or something like that. So you're being clear. We're not saying it never happens. They call that a half-truth. So in 2024, they fined Flagstar Bank $3.5 million for having a hypothetical risk factor when they had an incident that year that resulted in the exfiltration of public personal information of 1.5 million of their customers. You can't say something might happen when you know the bad guys have taken information on 1.5 million of your customers. They fined Unisys, a technology company, $4 million, again, for the same sort of hypothetical risks when they'd been hit by the SolarWinds incident and had gigabytes of data taken out of their network. The other thing we've seen, and we'll see how this plays out in the future, when we talk about sort of not second-guessing good faith disclosures, they have gone after some companies in the past about their disclosures when they did have an incident. What the SEC thought was minimizing the incident. So a technology company, Mimecast, was fined $1 million for misleading disclosures about an incident. Mimecast said the evidence showed that this certificate was used to target only a small number of customers. Turns out the database that got hacked had 31,000 customers in it, and the SEC said that's not a small number. You're minimizing it, and that's misleading. They also said that while the bad guys got some of their source code, that source code was incomplete. And the SEC said, well, but they got more than 75% of your source code on really key things. That's a lot. You can't minimize it and say it's incomplete. I think the takeaway there is you need to be as factual as possible and, avoid the adverbs and the adjectives and just try and stick to the facts as much as you can. The other point I want to make is about the approach to whistleblowers. And so Zach talked about whistleblowers and the importance of compliance. He talked about one is an instance where he thought the whistleblower was talking to a lawyer. I have an active matter right now where our whistleblower has told one of their colleagues that they're talking to a lawyer, and we know the name of the lawyer, and there's a whole industry out there of whistleblower lawyers who know how to put together a case that will get the government's attention, and so that's a real thing. I don't know about the AI part of it. We got the lawyer part of it. I don't know what the enforcement. we know that whistleblowers, so the SEC has an annual report that they put out this time of year, every year. Because the government shut down, it hasn't come out this year. But the Office of Whistleblower issues a report and tells you about the amount of tips that they get and the amount that they paid out. And they paid out last year, I think $225 million, including in one case, they gave two whistleblowers a combined $98 million. So these are real dollars at issue here. They may not, the only public information we have so far is I think there's only been 2 whistleblower awards in the last year under this current administration. So dramatically reduced whistleblower award payments. I don't know, I suspect when we see it, we're going to see that the tips and complaints are still high and they're just not turning into investigations. But what they are continuing to do is pursue companies who do things to prohibit or impede whistleblowers from getting to the government. That's Rule 21F of the SEC rules. And so we saw 11 enforcement actions in 2024 against companies who either through a non-disclosure agreement or a settlement agreement or an employment agreement or a separation agreement, put language in there that says you can't talk to the government, you can't get you waive your right to get a whistleblower award, or that you have to tell us before you go to the government, or you can't talk to the government voluntarily, you can only talk to them if you get a subpoena. The SEC believes all of that is illegal, and every year for the last 10 years has come out with many, many, many enforcement actions on those. They're trying to send the message to companies, stop doing that. And so I think the message there is continue to be thoughtful about drafting those types of agreements and making sure you're not inadvertently tripping over something there. I talked earlier about we're returning to sort of the basics on SEC enforcement. Bread and butter SEC enforcement is insider trading. So Catherine, talk about how how issuers can keep themselves out of trouble if the government's going to be focused on insider trading.
Well, this is where we bring it all home, right? This is an ethics panel. You're talking about don't lie, cheat, or steal. You're saying get your compliance program up in gear. So let's talk about insider trading and insider trading policies. This has been a big topic of discussion for several years at this conference because insider trading policies, as you know, now have to be posted with your 10K. So we now have a wealth of insider trading policies of all of the public company peers that you can take a look at and compare. But let's start with just a reminder of what insider trading is. This is an ethics CLE. Insider trading is transacting, that includes buying, selling, or gifting. That's a change from how this was treated 5 or 10 years ago. Securities in breach of a duty while possessing material non-public information with scienter. All right. Basic definition of insider trading. It's been around for a long time. The only development has been this real focus of the SEC in recent years on gifting transactions as opposed to buying and selling in the market. Another reminder from past years, a big development was the Panawat case, the shadow trader case, which you may have heard of. We talk about insider trading being trading, while you in violation of a duty, right? So a duty would be what an employee owes their employer. A duty of a spouse to a spouse employee, right? You don't take the information from your spouse or from your company and use it to trade for your benefit. The Panawat case was unique because there was an employer-employee relationship. Mr. Panawat was an employee of a company called Medivation. Medivation was going to be acquired by Pfizer. Mr. Panawat learned that information in the middle of a workday and very promptly turned around, and we can see he was in chats with his manager, so we know how quickly he turned around, and bought out of the money options in a competitor of Medivation. He has no duty to that competitor. That competitor was not a customer or a supplier or had any other contractual duty running to his employer. For many practitioners, we view the chain of duty being broken in that case. And yet, the SEC brought insider trading charges against him and were successful under this kind of shadow trading analysis. This all was happening at about the same time as we had to start posting insider trading policies with our 10Ks. And the most frequent question that I got for a year was, Well, what do we say about shadow trading? Well, what are our peers saying about shadow trading? Well, what should we do about shadow trading? We don't think shadow trading should be covered by our policy. And there are a lot of different approaches to it. But like I said, the good news is that now we have a year of information to mine, over a year of information to mine. And I have a summary of insider trading policy provisions here for you. So I have just listed kind of the most common answers to the most common questions here. If you have specific questions and you want to talk about your policy, do feel free to reach out to me. So starting at the top, blackout periods. The beginning of the blackout period starts in most cases 2 weeks before quarter end, sometimes can start up to the date of quarter end. That's the range of dates that a blackout period starts. End of blackout period is most often 1 to 2 business days after the release of earnings. So that would be your earnings release, not your 10Q. That's pretty in line with the advice we've been giving for years. Your blackout period may start 5 days before quarter end. It might start 10 days before quarter end, but as long as it's in that 2-week period, that's fairly normal. The persons subject to quarterly blackout are most often directors, Section 16 officers, and then there will be some definition of designated employees. And that's what the catch-all you would use if you wanted to bring in your accounting team or your legal team, or if there were a special, trading block for certain folks who were notified, that certain designated employees group gets pulled into the blackout group. When it comes to preclearance, most often it's that same group that's subject to preclearance: directors, Section 16 officers, and then certain designated employees, however that's defined for the specific company. Here's one that not all policies have, and it is: how long does preclearance last once granted? Does it last forever? Does it expire after 24 hours? Does it expire after 5 trading days? And that's a decision that your company needs to make. Most often where we see those cutoffs, we see it between 2 and 5 trading days. And at that point, your preclearance expires and you have to go back to the preclearance officer, usually your legal team, and they'll pre-clear you again. As part of that, you really need to think about how you handle limit orders. Limit orders theoretically can last quite a long time, right? I want to sell X number of shares as long as the price hits Y. Those need to be time-bound, or they need to be 10b5-1 plans. That would be the more conservative answer under an insider trading policy. Pledging and hedging across the board is still being prohibited. We see some very specific exceptions, almost always in a founder-led company where the personal wealth of the founder or the founder group is tied up in the stock. Elon has some pledging and hedging exemptions. He's a good example. ISS and Glass Lewis will look at those exemptions carefully. They want to see demonstrated ability to repay, and they want that percentage of that person's ownership to be kept and capped fairly low. So that can be done. It is not often done, but it is something you can discuss. Gifts. So practice is still somewhat mixed, but the majority now treat gifts as the same as regular transactions. Some insider trading policies will set conditions around gift giving, but more often than not, insider trading policies are treating gifts the same way they would open market trades. Gifts, by the way, also include estate planning transactions. Often estate planning transactions are treated under Section 16 rules as gifts among family trusts or among family members. So that's something to keep an eye on, and it always causes trouble. Here's the list of other common exceptions to the policy. You'll see, especially with respect to compensation grants or vestings, but no associated sales into the market. Those are usually cut off. I included one here at the bottom that you should think about if you don't have. If you have ever run into a situation where one of your Section 16 officers or directors is going through a divorce and the divorce decree comes down during blackout, I recommend you think about adding this last exception or giving yourself a waiver. There are family transactions, death and, will transfers happening pursuant to wills that are difficult to manage the timing of, and it's good to be thinking in advance about that. It can be very meaningful to important directors that you have a plan. Ability to grant waivers. Practice is still mixed. A minority of policies allow for waivers, and where they do have waivers, they give that power usually to the GC or the legal department. Again, something to think about whether it works for your company with your counsel, but I think that is something to think about. It can be very helpful, again, in very specific scenarios because weird things happen all the time. And then finally, shadow trading. This is the one that I get questions about more than anything else. And I have to give you the most lawyer answer ever, which is, it depends, or practice is mixed. There does not seem to have been a consistent response to the Panawat case. There is consistent language that you will see through most insider trading policies, and that is, you may not trade in securities of the company's customers, suppliers, and strategic partners based on information learned through the course of your employment. But you can see kind of the chain of duties in that, right? I have a duty to my employer. My employer, has a contractual relationship with suppliers, customers, and strategic partners. So if I trade in those customers, strategic partners, et cetera, I am breaking this chain of these chain of duties, right? But pure shadow trading, we haven't seen a consistent response. Sometimes a policy will describe the Panawat fact pattern or reference shadow trading directly. Some policies will refer to competitors generically or economically linked entities. So that would be, I suppose, companies that are within the industry, right? That's going to be really hard to police, and it's going to be really important to train your employees on that. So I would flag that if that is part of your policy, to really make sure as part of your training that you're explaining to your employees exactly what that means. Because again, it's a step further than any of us have really thought about insider trading historically. All right. And then the last bit, again, this is showing up in most of the Fortune 100 at this point. So this is filtering down. If you didn't get it in your first round, it's probably a good one to add in. In item 408 of SK, a public company is required to disclose whether it has adopted insider trading policies governing transactions by itself. So the company's own trades and its own securities. A lot of companies ignored this. A lot of companies now are adding this language to the end of their insider trading policy so that they can put it in their proxy, that they have a policy. And the policy is very generic. It's something like, from time to time, we'll transact in our own securities and we'll comply with the law when we do so. And that's your policy. So I recommend adding that at the end just so you can report in your proxy that you have adopted a policy. But that is the language that's really crystallized to deal with that item 408B disclosure. All right. I'm taking one more sidebar. Again, we've talked about don't lie, cheat, or steal and have policies in place. So Sarbanes-Oxley came down in 2002, 2003. It has been a long time since anybody has probably really talked about this with you. There are young attorneys in this room who I suspect were toddlers when this rule came down. So I just want to sit down, level set, and remind us that we have certain ethical responsibilities under Sarbox that you probably get an insider trading compliance training every year. You may not get a Rule 205 training every year. So this is your opportunity. Get excited. So just a reminder, Sarbox was adopted in response to public company accounting and disclosure scandals. There were two pieces that applied to the to attorney conduct and sanctions. One is about actions misleading auditors for the purpose of rendering financial statements misleading. The second directed the SEC to adopt minimum standards of professional conduct for lawyers appearing and practicing before the SEC. Appearing and practicing before the SEC will become crucial in this conversation. So remember that phrase. But let's talk about the first. It's unlawful for directors or officers or those acting on their behalf to fraudulently influence, coerce, manipulate, or mislead an accountant auditing the issuer's financial statements for the purpose of rendering such financial statements materially misleading. this feels fairly comfortable to us as attorneys, right? We're sitting here thinking to ourselves, hey, no problem. I'm not going to lie, cheat, steal, or mislead my auditors. I'm not going to provide an auditor with an inaccurate or misleading legal analysis. This is an obligation that feels fairly simple to comply with because, as a general rule, I myself am, I believe, an ethical person who tells the truth, right? So you're looking at this one and you're thinking, okay, fine, I can deal with that. I'll just continue, being my own ethical self going forward and give honest reports to my auditors. I think the more interesting one is Rule 205, because Rule 205 puts an affirmative obligation onto attorneys to act. It's not a negative obligation. Don't mislead your auditors. It is an affirmative obligation of attorneys appearing and practicing before the SEC to take action if they see certain things happening. So Rule 205 was effective August 5th, 2003, applicable not only to securities lawyers, so you don't have to be a capital markets lawyer for this to apply to you, but also to other lawyers who probably wouldn't think of themselves as securities lawyers in front of the SEC. The basic thing to remember about Rule 205 is when an attorney appearing and practicing before the SEC becomes aware of evidence of a material violation, the attorney has to report it up the ladder and may have to take follow-up actions. Well, what does this mean? If you see the misconduct, you have to report to your chief legal officer or CEO. And if that lawyer does not take action, you then have to go to the board or an audit committee. So it is an affirmative reporting up obligation. First, you tell your chief legal officer, you wait to hear back from them. If they didn't deal with it, you've got to go to the board. And that is your obligation as an attorney who sees this misconduct. There is the option to report out, but it is not required. It's the report up that is required. So here are the triggers. You're an attorney appearing and practicing before the SEC, aware of evidence of a material violation. And it's this appearing and practicing before the commission that can be really scary, because that's doing any business with the SEC, providing advice on US securities laws, advising whether any information, statement, opinion, or writing is required to be filed with the SEC. So here's where people get frightened, right? Clearly, if you're the assistant general counsel of your company whose job it is to review all the 10K filings, you are appearing and practicing before the SEC. But if you are, I don't know, a tax lawyer who is drafting reps in a material contract that's going to be filed with the SEC, does Rule 205 apply to you? Do you have any idea whether it applies to you? Does your company have a policy in place that tells its lawyers that Rule 205 might apply to it? That's what's scary. It is a broad pool of folks who can get pulled into this. And it's folks who don't consider themselves to be securities lawyers who deal with the SEC on a regular basis. That's what's scary. The material violations are violations of the securities laws, breach of fiduciary duties, or similar material violations. We don't have a lot of information on what those are beyond what is put in here. So here's the decision tree for our chief legal officers and our attorneys out here. The step one, step two, step three goes up, reports come back down, it goes up to the board. I've laid that out for you here. I will note, again, for our most junior attorneys, your obligation actually stops at your supervisor. So subordinate attorneys can go just straight to their supervising attorney. It's the supervising attorney who then has to report up the ladder. So if a report comes into you and you're somewhere in the middle, just know that you also have an obligation to report up the ladder. It can't stop with you. So what are the consequences of this rule that you may never have heard of? Civil penalties and remedies under the Exchange Act, they could bar you from appearing in front of the SEC. They could have civil penalties. There could be SEC disciplinary proceedings, of course, adverse publicity for your company and yourself. I will note, and this is the part where you can all take a deep breath, we are not aware of any Rule 205 enforcement actions in 23 years. Obviously, there has not been an appetite to bring these, so maybe that's the part where you take a deep breath. In past administrations, we have heard SEC commissioners raise item 205 and mention it as a possibility. Under this administration, I suspect it would not be a priority. So just your little Rule 205 update that maybe you haven't thought about, and if either haven't heard about or haven't thought about in a few years, and something to remember in case something happens to you. Thank y'all. Good afternoon, everyone. We're going to go ahead and get started. And just a quick note for everyone that it is a straight hour and a half now through the end. So if you need to grab another bottle of water or do whatever you need to do, go for it. But we're here to talk about Delaware versus Texas, about Dexit. My name is Catherine Frank. You just saw me on the last panel. I am a corporate and securities partner based in Dallas. And I have with me
Quentin Smith. I am based here in Houston. I'm a commercial litigator. I also sit on the Rules Committee of the Texas Supreme Court, or also known as the Texas Supreme Court Advisory Committee.
It's cool. I didn't know that, actually. Okay. So I woke up this morning at 7:23 Central to an alert in my inbox that I was barely able to get into our slides in time, which is that Mr. Paul Grewal, who is the CLO of Coinbase, has put an op-ed in the Wall Street Journal explaining that Coinbase is planning to reincorporate to Texas. In fact, they've already gotten the requisite shareholder consents to pull that off. They filed their information statement this morning. So very rarely do I get to talk about news that is quite this timely. And I actually have an even more timely announcement, which I will share later. But Mr. Grewal wrote a pretty good op-ed, and you should take a moment to read it if you get the chance. He cited the judicial surprises in Delaware and Texas efficiency and predictability under its recent law changes and the Texas business courts, as well as Texas's pro-business atmosphere as reasons that Coinbase has decided to move to Texas. And you can see Coinbase is not alone. We've had a few more Delaware to Texas reincorporations, Tesla, SpaceX, Dillard's, Zion Oil and Gas, and as part of a bigger migration out of Delaware and into other states, Nevada being the other most common destination for public companies. Now, you might say, okay, why? And why these companies? And what happened to Delaware? And what changed in Texas to make it a destination of choice? And that's what I want to talk about with you guys for a little bit here. But I want to start by level setting and explaining the characteristics that some of these companies that have moved share. And Coinbase is a good example of this. So Coinbase talked about the lack of judicial predictability in Delaware. Sometimes we might say, Delaware is home to opportunistic and frivolous litigation and increased costs. You know, it's costs both in terms of legal fees, management time, D&O premiums. And Texas has passed some recent laws to help limit this lack of predictability, which we'll discuss as we move on. But let's talk about that circle first. And I always, by the way, in my mind, envision this as a Venn diagram in which the circles overlap. So the first group would be companies that worry about increased risk of opportunistic and frivolous litigation. All right, category one. Category two, controlled companies. Controlled companies bear a burden in the Delaware courts that's really hard to meet. And that means, you know, the review standards are high enough that they can almost always expect excess litigation, unpredictable costs, or unpredictable results and high costs. Okay, so we've got opportunistic and frivolous litigation, controlled companies. The third group of companies that tends to ask about moving to Texas or that have moved to Texas are companies that I would say they're true believers in the Texas mission, right? They want to be they either have operations or headquarters in Texas, or they believe that Texas is the pro-business future, right? And so that's a Venn diagram with overlapping circles. And you can see that Coinbase Dillard's, Tesla, SpaceX, they all fit in that Venn diagram in different places, right? So Coinbase talked in their CLO talked in their op-ed about how concerned they are about litigation costs in Delaware. So we can check that off our box. What he doesn't mention is that Coinbase is a controlled company. Their founder controls over 50% of the stock. Coinbase is headquartered in New York, but it is a crypto company. So if you go look at their SEC filing, you'll see that they mention, hey, we're really interested in moving to Texas because Texas politicians and the Texas environment is really pro-crypto. And we really want to be somewhere that appreciates our mission and our product. Okay, so Coinbase sits right in the middle of that Venn diagram. Another example is Tesla. Tesla is not necessarily controlled by virtue of number of shares held by Elon, but you may have heard that he's a powerful presence in the boardroom. And so they have a controlling or conflicted shareholder aspect coming in from Elon's ownership. Same with SpaceX. Both Tesla and SpaceX have significant Texas ties, headquarters, manufacturing facilities. And Elon has said, Texas is the pro-business future, right? And of course, Elon has been burned by the Delaware Chancery, right? So there's definite concern about opportunistic and frivolous litigation. They fall right in the middle of that Venn diagram. The third company is Dillard's. Dillard's is headquartered in Arkansas, but is controlled by the Dillard's family. They hold something like 60% of the voting shares, and most of Dillard's stores are in Texas with no stores in Delaware. They also mentioned that they went through several recent franchise tax audits in the state of Delaware that were incredibly painful in terms of management time and attention. So again, they fall somewhere in our Venn diagram. When I take calls from folks asking if they should move to Texas or wanting to learn more often than not, they fall into one of those three categories or multiple categories. So as we move forward through this presentation, I would encourage you to think about whether your company falls somewhere in that Venn diagram, and if this is something that your board needs to hear about. Whether they need to move, I don't know. That's a decision that your board would have to make. But if it's something they need to hear about, this information can be helpful to them. Okay, so what got us here, right? What was the problem in Delaware? Well, you may have heard the tweet heard around the world from Elon when Chancery came down and invalidated his $56 billion pay package. This was the $56 billion one, not the trillion one that was approved earlier this week. He successfully moved to reincorporate Tesla and SpaceX from Delaware to Texas in 24. By the way, that case, that lawsuit to invalidate his pay package was actually brought by a plaintiff who held only 9 shares of Tesla. So someone who is very focused on, a successful suit, but not really a large owner of the company. The TripAdvisor cases were happening slightly afterwards. So at this point, TripAdvisor, which was a controlled company, was looking to leave Delaware to move into Nevada. And it sparked this case that we call the Hotel California case. You can check in, but you can never leave. The Delaware Chancery reviewed the decision to reincorporate, and because it was a controlled company, they found that the directors had a non-ratable benefit that they received because of the move in the form of decreased litigation risk. So they reviewed the whole thing under entire fairness. Eventually, the Delaware Supreme Court overturned, but at that point, the damage is kind of done. And the Delaware legislature worked very quickly to create a legislative safe harbor for transactions with controlling stockholders or with conflicted D&O transactions. So here I want to pause because I know this is Texas versus Delaware, and I've been talking a lot about coming to Texas. Here, if you're a Delaware corporation, this is your Delaware corporate law update for the day. So wake up, pay attention. Reminder that these laws came through this year. There is now a codified process to approve conflicted transactions with controllers or with conflicted Ds and Os. And it involves either a special committee of duly appointed independent directors, and there's a definition of independent directors we'll look at, or approved by a majority of the minority. but that has now been codified. You can look at it, reference it, put it in your board resos, and it's something to be thinking about if you do have a company that has to deal with those kind of transactions. Interestingly, the definition of disinterested director under the Delaware Code ties to the stock exchange rules, which is kind of interesting. So, yeah, you can see here, directors of listed public companies. So that's your Delaware governance minute, that law change. But like I said, the damage had been done. And you see this in the Coinbase op-ed where he says, hey, you know, credit to the Delaware legislature where it's due. You know, these rulings came down that have made companies nervous, and the Delaware legislature acted quickly. But the litigation, you know, the litigation posture in Delaware is so risky that for us, we think we're going to do better in Texas. So what is different about Texas? What changed? What are the benefits that you get under Texas law that are so compelling to these few companies, again, often companies who exist in this Venn diagram, that they decide that it's worth going and getting a shareholder vote to make the move, right? Because it takes a shareholder vote to move. There were 3 sets of laws that came down early this year, and you can really boil down the benefits into, well, I guess these 7 items, which are quite large, quite a long list, but they're important. And I want to go through them one by one, but you can also see them. We've laid them out nicely in a comparison chart on the next page so that you can see, you can compare the rules side by side. But the first and most important change was the codification of the business judgment rule in Texas. It was a bill called SB 29. And by codifying the business judgment rule, they've made it unlikely that Texas courts will review actions under enhanced scrutiny or entire fairness. And there never was enhanced scrutiny or entire fairness under Texas corporate law. But now the law says, has codified business judgment. So in other words, a court will defer to the board, even if in hindsight, it would have made a different decision, right? We're basically making the world more predictable for boards of directors to run their business. And that rule applies automatically to Texas corps. If you're a private corp, you can opt into it as well. The second item that is, I think, of most interest, especially when it comes to limiting opportunistic and frivolous litigation, is the ability to defend against derivative suits. So Texas corporations may opt in to a 3% minimum ownership threshold before a plaintiff can bring a derivative suit. A 3% ownership threshold. So remember that Tesla, the pay package dispute was because of a plaintiff who owned 9 shares. Presumably, if Tesla had been a Texas corporation at the time, it was not. And if this rule had existed, it didn't. They could have set the threshold at 3%, and that suit never would have been brought. There are also certain statutory rules in Texas that have actually been around for a long time. They aren't rule changes. Texas corporations and Texas courts are deferential to board committees who can accept or reject derivative claims at the committee level at the board instead of basically pleading futility and going back up to the court. It's a lot easier to stop a derivative claim at the board level in Texas than it is in Delaware. That's not a new change, that's a side note. Like Delaware, Texas adopted provisions that allow a committee of independent or disinterested directors to approve conflicts or controlling stockholder transactions. That's now fairly parallel between the 2 states. The third group are these next 2, waiver of jury trials and the exclusive forum provision. So in Texas, the default is that everyone gets a jury trial and that all judges are elected, right? We now have the Texas business courts, which my friend Quentin is going to talk about at length. And these provisions were put in place to allow companies to take advantage of a chancery-like Texas business court. In your governing documents, you can waive jury trials, and everyone's deemed to have notice of that. And you can set exclusive forum for internal entity claims for the Texas Business Court. So it essentially allows Texas corporations to opt into a system that looks a lot like Chancery. And that's the point of those two provisions. The last two bullets on this slide are by far the most controversial. The first is a shareholder proposal ownership threshold. And I do want to flag something because I want you to see the summary here on this page. So for corporations that are either headquartered in Texas or listed on a Texas stock exchange, headquartered in Texas or listed on a Texas stock exchange, you may opt into a shareholder proposal threshold, much like the derivative litigation threshold, that's at 1 million or 3% of the shares. So to put a proposal on the ballot, you need $1 million or $3 worth or 3% of the shares. But note that it's not just generally all Texas corporations. It's corporations headquartered here or listed on the stock exchange. So today, this morning, we got an announcement that after many months of rumors, the NASDAQ Texas is going to exist. They're going to call it the NASDAQ Texas. That press release came out late breaking, too late to make it into our deck. They, along with the NYSE Texas and the Texas Stock Exchange, we expect to be the three Texas stock exchanges that allow you to be eligible for this rule. Once you co-list or dual list or IPO on one of those exchanges, presumably you set a threshold in your bylaws or your governing documents that would limit the ability of shareholder proposals to come through. That's so different than 14A8, which is what y'all are used to, where it's fairly minimal ownership requirements for certain gadfly investors to submit governance proposals annually. Chair Atkins came out earlier this year and said that his administration or his commission would defer to state law on this matter. But it is an area that could be controversial because 14A8 is much lower than what this Texas threshold would be. So we're going to have to see if a future administration comes back and challenges this or tries to have some sort of federal preemption of the state law. But for now, it could be a powerful tool for many corporations who are headquartered or co-listed on a Texas stock exchange. And then the last item on my list here is the proxy advisor rules, which are currently in court. ISS and Glass Lewis sued the state. And so it's now stayed. But basically, the proxy advisor rule, Texas put adverse disclosure requirements on ISS and Glass Lewis or other proxy advisors who make recommendations contrary to management based on non-pecuniary factors, very specifically ESG-related recommendations. So it's trying to, make those stop. You've seen you may have seen Glass Lewis and ISS coming out. Glass Lewis said they were getting rid of their house rules. That's part of this controversy. It's also part of the reason that if your company decides it does want to reincorporate, like I said, it takes a stockholder resolution or a shareholder vote. You're probably going to get an adverse recommendation from ISS and Glass Lewis. They recommended for Tesla. I don't believe they've recommended for since. And if you look at their policy recommendations, they say something like, we need, given what they see as fewer shareholder rights, that they want to see some compelling reason for a move, and that cost savings aren't enough. Typically moving from Delaware, you save maybe $250,000 a year in franchise taxes. So that's often cited as a reason to make a move. They said that might be enough for a small biotech, but that's not compelling for a large company. So something to be thinking about as you move through this analysis for yourself. But we wanted to be here just because, again, we have gotten so many questions on this. We have been involved in and helped advise some of these companies move into Texas. And we know that boards want to know what's going on. So to the extent you have additional questions, please let us know. And I hope the chart helps you as you think about talking through this with your board.
All right, thank you, Catherine. So going to give a quick overview of the Texas Business Court. It is the Texas Business Court, not the courts. There are multiple divisions, but it is just one court, which people often get confused. For those of you who don't know, there is some breaking news. I guess this is the week of breaking news, but the first business court trial was held last week, and we got a decision yesterday. It was a bench trial. It was a case involving Winter Storm Uri and gas sold during Winter Storm Uri, or gas not sold during Winter Storm Uri, a claim of force majeure. The judge held a bench trial and ruled in favor of the defendants who did not provide the gas. And there is a written decision. It is only 3 pages, but we now have a written decision explaining why the force majeure applied. And so that is the first chancery-like opinion after a trial in Texas. So that's what we have as an update. And so I'm just going to go through at a high level of some of the new aspects of the business courts which changed this year, but also kind of give a general overview of why people might want to consider the business court. So for those of you who don't know, there are, several reasons why people might want to litigate in the business court. The idea is that you can have a faster pace of litigation, more robust jurisprudence, more predictable legal outcomes, and potentially lower costs. And so the question is, how does this happen? Like, it's just a court. That doesn't mean you're going to get these things. And the key is something that Catherine mentioned earlier is the judges that are appointed to the business court. And I said appointed because they're not elected. They have 2-year terms, and the governor gets to appoint them with advice and consent from the Senate. But they are basically on probationary status as long as they are doing good behavior for each 2-year term. According to the governor, then they get replaced, right? So there's kind of oversight from political level of these judges that are reappointed every 2 years or replaced in a 2-year cycle. So that's how you get to some of these outcomes. And so the faster pace is that they are setting trials quickly. We have a couple of cases in the business court right now, and they have been set very fast. And so you're going to get decisions faster. You're going to get better selected judges, and hopefully you get more predictable legal outcomes. And if you don't, then there will probably be a call from Austin. All right, so here's a list of some other considerations for the business court. And I want to focus on kind of the last 2 boxes, mostly to reiterate that the business court is still a court of limited jurisdiction. Just because you agree that you want to be in the business court does not mean you can always get there. So for the most part, the business court allows people to get in with a $5 million threshold for qualified transaction and derivative proceedings and other various laundry list of items. But if it involves a commercial transaction with at least $5 million, chances are you can probably get into the business court. There's also an exception as well. If you are a publicly traded company, then the laundry list, including derivative proceedings, you don't have a monetary threshold. You just automatically get to go to business court. So that's kind of one of the selling points to public companies for the business court, is that if you're a publicly traded company, then you can just get right into the business court. One of the, and I'll touch on this later, the qualified transactions piece has a little bit of a catch. And so I will touch on that a little later because there's some interesting decisions that came out about that. But that's generally how you get into the business court. This is just a graphical display of kind of where the business court sits in relation to other courts. It has concurrent jurisdiction with the district courts, so it can hear the same types of cases. But also, along with the business court, was the creation of the 15th Court of Appeals. And that is one of the things that when I'm advising clients on whether they should litigate in the business court or not, I think is a true benefit to litigating the business court. So the 15th Court of Appeals is kind of the exclusive court that will hear all appeals from the business court. And so it is also elected judges, but they're elected statewide. So they're essentially like Texas Supreme Court judges, right? So you're going to still get high-level jurists, people that are really interested in the position, but also you're going to know who the decision makers are when it comes to an appeal of any decision. And I think that is one of the truly unique things about the business court. So look, arbitration, we generally don't have a right to an appeal. Federal court, let's say you're in the Fifth Circuit, you don't know who your panel is going to be. It's going to be 3 judges from anywhere, and depending on how your panel looks, it's going to change how the outcome of your case. But at least with the Texas Business Court, you're going to know exactly who's going to be holding oversight over any business court decision, whether you're trying to hold on to your decision or trying to flip it. And so I think that is one of the true benefits compared to other venues as well. So this is just a display of kind of where the cases have been filed as of September 3rd. I've attended a couple of conferences with the business court judges, and there are, I believe, over 165 cases now in the business courts. But most of the cases are in Houston. And in fact, so many cases have been filed in Houston, they're using business court judges from other divisions to help out with the Houston caseload. And so that's not surprising, as Houston is the largest metropolitan area in Texas, but also has a large legal presence as well. Here are your business court judges. These are jurists that are highly thought of. But this just give you a little insight into who some of these people are. Grant Dorfman is in Houston, but he's also the administrative judge for the business court. So he kind of decides different aspects of the business court, who gets what cases when there's kind of overflow from a particular division. Finally, just wanted to let you know, we actually are tracking all of the business court cases at B&E, and there's a QR code to our business court website. But we provide summaries quarterly of all the decisions that have come out of the business court. There haven't been that many interesting substantive opinions recently, but one of them relates to the qualified transaction that I mentioned earlier. So qualified transaction has been determined to be a consummated qualified transaction. So a breach of contract where the contract was signed. So if you're suing for, tortious interference of business opportunities where you didn't have a contract, that would not necessarily qualify as a qualified transaction because the transaction wasn't consummated. And so there would not be business court jurisdiction. So that's kind of one of the cases that has come, or the decisions have come out on jurisdiction in the business court. And we've been providing updates like that on our website. And I believe that is the time we have because we're trying to move to the next presentation. But Catherine and I are free to answer questions outside or afterwards. Feel free to contact us. Thank you.
Good afternoon, everyone. My name is Regina Ibarra, and this is my colleague, Kat Smith. And we're presenting on the riveting topic of executive compensation. So today, our presentation will consist primarily of 4 different parts. The first part will be an overview of the SEC's roundtable, and they're thinking about making changes to executive compensation disclosures, which Kat's going to discuss. Then we'll talk about severance for involuntary terminations of employment. Then a little bit about perks, everyone's favorite topic. And then lastly, we have some new ISS proposed changes for comp disclosures that we'll touch on a little bit at the end.
All right. So you guys may have heard, if you're in the exec comp space, you definitely did. If you're not, you may have heard about the SEC roundtable on executive compensation. And that was this summer. We'll kind of start here. Here we go. With a little bit of background, just in case this isn't your primary area of practice. So most of the executive compensation disclosure that we see every year is in the proxy statement. And almost all of those rules are under item 402 of Regulation SK. That came out in 2006. So those rules have been around for a little while. Most of the balance of them came from Dodd-Frank, and they've kind of trickled out over the last many years since Dodd-Frank was enacted. And so Commissioner Atkins came out this summer and said, hey, this is kind of a mess. And it is. We have sort of this patchwork of rules that maybe started in a coherent fashion, but we've added on, and now we have kind of a lot going on. We have some duplication, we have some complexity that maybe wasn't the original intent of the folks who came up with this, this disclosure regime. So he said, hey guys, everybody go out and think and tell us, what would you change if you wanted to change some things? And so that's what the roundtable was about. It was getting a lot of people in this space together, whether they're investors or they're issuers, and saying, what isn't working for us? What would we like to see? What do we think is just dysfunctional? Tell us your ideas, brainstorm. It was pretty much a full day event. And it was very, very interesting, at least for people who are working in this space and doing this disclosure and preparing this disclosure. So we're going to talk a little bit about some of the different opinions and thoughts and brainstorming that went on there. So the next few slides, we're going to move through pretty quickly. They basically just summarize what the different commissioners had to say. They each issued a statement before the roundtable. And there's a lot of overlap between what they had to say and what the people at the roundtable and the folks who had commented since then had to say as well. But, you know, there was, you can see here that Commissioner Pierce wasn't a fan of pay ratio and pay versus performance. That is a common theme that we will see again and again here. He focused on the time and expense of preparing the disclosure, saying this is just unreasonably expensive and time consuming. And he had the concern that the comp disclosure was directing rather than reflecting corporate actions. And I can tell you in my practice, I see that every day. You know, one of the first things that my clients call and ask when they're thinking about designing a new comp or making a comp decision is, what is the disclosure implication of this? What am I going to have to say? How am I going to have to say it? How prominent is it going to be? And, you know, to some degree, that's good, right? They're thinking about, how are my shareholders going to react? How are they going to see this? What is their view going to be? But that's also kind of the cart driving the horse a little bit. And I think that's what he was trying to get at there. Here you're seeing Commissioner, I may be saying this wrong, Ueda's comments. And, you know, he focused a lot on how pay ratio is kind of a name and shame disclosure. That the idea there is just to kind of embarrass a company and embarrass certain industries in particular. And that's not necessarily an incorrect position. You know, I think that is probably the primary purpose. We're going to talk more about that as we move forward, and why pay ratio is somewhat problematic, but we're going to just roll through these. And then Commissioner Crenshaw was not at the meeting, but did issue a statement in advance. She had some interesting ideas about gap reconciliation, which I think most of my clients would not be excited about. And, you know, did bring up the, you know, the impact of some of the guidance on 13D and 13G that I think was discussed a little bit earlier in the presentation, and that we may come back around to here in a little bit, but that is kind of, I would say, potentially muffling some investors' input on executive comp. So what were the takeaways from the roundtable, the actual in-person meeting that happened? Criticism of expansiveness and expense of the framework. We just talked about that. Pay versus performance, pay ratio, perks, and clawbacks were the biggest target of people's ire. And I'm sure that may be true for you internally, if you are an issuer who has to do this disclosure as well. You know, there was an interesting, I thought it was interesting that quite a few people brought up a potential change to who the NEOs were. So that's who you make that disclosure about. There seemed to be kind of a movement towards, let's make this about fewer people, right? Maybe just 2 or 3 people instead of 5 or more people. And there was some discussion about XBRL tagging of comp data, which would make it much easier for people to pull that data and compare it across companies. I thought that was kind of interesting. And then, of course, there are some folks who said, hey, you know what, no matter what we do to these rules, as long as you have institutional shareholders and ISS and Glass Lewis sort of directing policy in a lot of ways, or at least directing shareholders voting on things like, say, on pay, that's going to continue to drive things in a really material way. That the first question I get when we're talking about a comp change is, what are the disclosure implications? And the second one is, what is ISS and Glass Lewis, what is their response going to be? So that will still be at play. I'm just going to take a couple minutes to go over some things that came up in the comment letters. A lot of it would be repeating what we just talked about, but I thought there were some very interesting ideas that had come out of these comment letters. It'll be interesting to see how many of them are implemented or not. I do think that we will see changes in the 402 disclosure rules. I would be surprised if we don't, but the question is, how big are those changes going to be? Are they going to scrap the whole system and start over? There are some limitations to that, which I'll talk about in just a second. Or are we just going to see some minor changes around the edges, right? As I mentioned, some of the disclosure obligations that we have for executive comp are called for by Dodd-Frank. And so those are in a statute. We would have to amend Dodd-Frank in order to completely eliminate things like pay versus performance and pay ratio. But I will say that the actual, rule itself, the actual law is maybe 5 or 6 lines. So we have some flexibility to change, even if we do not have the flexibility to eliminate without congressional action. So that's something to think about. Maybe one of my favorite suggestions out of the comment letters was to just eliminate the summary comp table and maybe also pay versus performance and create 2 tables, one that is target comp and one that is realized comp. I think that would be very simple. I think that would probably get at what most investors are most interested in. So I thought that was an interesting suggestion. We're going to talk more about perks here in a little bit. So maybe we kind of talk more about what was suggested there when we get to the perks section. But there was also a lot of discussion about the way that we report equity awards. So the value of equity awards is reported with the grant date fair value, not how they actually shake out. So whether they vest or not doesn't impact the summary comp table. They're not reported at the time they vest. They're reported at the grant. That is inconsistent with the way we report all other comp in the summary comp table, which is when it's actually paid or earned. And so there is a lot of brainstorming about how do we fix that disconnect, both in amount, because it doesn't reflect what people actually wind up getting in their pocket, and timing, because it's at grant rather than at vesting. So I think that's something that we'll see some change on one way or the other. And then there was a lot of focus on pay versus performance and how to simplify that. This has become the most expensive, complex, time-consuming part of the exec comp disclosure. And I don't think that was the original intent. I think it's something that has kind of snowballed into a beast that's bigger than was intended. And I think I would be very surprised if we didn't see a simplification of the pay versus performance disclosure. That may mean, limiting the number of people we're talking about to perhaps just the CEO and leaving the other NEOs out of it. That may mean eliminating some of the many, many, many columns that we have in that table. That may mean sort of harmonizing some of the inconsistent time periods that we talk about. So for example, the compensation actually paid is per year, but the total shareholder return is from the first year in the table. So when you're comparing those 2 numbers, you're looking at 2 different time horizons, which is best confusing and at worst misleading. So I think that there's some motivation to sort of revisit those rules and find ways to simplify and improve them and hopefully lower the cost of complying with them, because there's a lot of legal costs, there's a lot of internal time at the issuer, and there is a lot of cost in working. Right.
Valuation costs for things like options, where you need to go and get a Black-Scholes value at the end of every year for every vesting date, for every forfeiture date.
It's particularly expensive when you have multiple vesting dates throughout the year instead of just one. You know, if you have monthly vesting, that can become a very expensive and time-consuming endeavor, and you almost universally have to hire a third party to do that. So those are where I think we're probably most likely to see changes. But one thing to note is that, and then we'll move on to the next subject, but the SEC is still accepting comments on this. So if anyone out there wants V&E to help you submit a comment, we'd be more than happy to do that. We have a lot of experience in that area, and there's still at least a little bit of time to get that done. So something to think about.
Thank you, Kat. Moving along to what happens at exit when the ride is over. And focusing, we've seen a lot of attention in recent months, years, from ISS and Glass Lewis for executives who terminate employment and are paid severance, but the disclosures may not necessarily describe that termination event as an involuntary one or an involuntary termination without cause by the company, but yet the executive is receiving severance or having a lot of equity vests. And ISS has not been very fond of this. So we're seeing an increase in focus from these proxy advisory firms on this issue, and an increase in no vote recommendations for your say on pay proposal when you've had one of these events happen in the last year and your disclosures are not clearly classifying the termination as an involuntary one. There are some limited exceptions, so we're going to get in at the end. What can you do about this if you're wanting to mitigate the possibility that you may be getting a no vote recommendation when an executive terminates? So where does this kind of situation arise? Well, there's mainly 3 different types of termination scenarios where we see this problem. One could be you have an executive who retires on favorable terms, maybe a longstanding executive, spent many years at the company, is now at the point in his career or her career where a retirement is the next step. And the company has appreciated the loyalty and the services of the executive and doesn't want that executive necessarily forfeit all their equity awards when they smoothly, timely retire. And so the parties may then enter into some kind of an arrangement where the executive gets accelerated vesting of equity or is allowed to continue to vest in equity, maybe just subject to a non-compete or something like that.
And this may not be entirely out of just the kindness of their hearts, right? I mean, sometimes you get to a point where someone is nearing retirement, but they don't want to retire because they will be walking away from substantial equity awards that would vest over the next couple of years. But it's kind of in everyone's best interest for them to go ahead and go. And so, you know, if you can't accelerate at least some of that equity, they may overstay their welcome a little.
Right.
And so this has been a very common way of helping people out the door
Yes.
when it's time.
Right. And another scenario is when the company affirmatively is making a decision that this is really not going to work out in the best interest of the company. We think we need to move in another direction. We need to let this executive go or encourage this executive to resign and look for a successor. And so, and they may not want to disclose that termination as an involuntary one by the company without cause. They've got PR to worry about. There's the reputational harm to the executive who may be concerned about a public broadcast of him being let go by his company, and just employee relations issues. So for those reasons, there might be some reluctance to qualify or disclose the termination as an involuntary one. And then the third bucket being, as you were touching on, where maybe the parties are mutually agreeing to a termination because it really is, it's time. And maybe the executive wants to leave and the company's glad to have the executive leave, or it's just something, maybe like a third bucket, just a softer termination without cause. So some common language that we do see in disclosures that companies like to use and have used in the past a lot are things like step down. They've mutually agreed to separate or to part ways, or the executive's departing. Historically, companies have worked hard to try to find a way to characterize the termination without saying, we let someone go, basically. Resignation, retirement, transition, separation, these are all words that we've commonly seen in disclosures. And what kind of benefits are we talking about? In some cases, it might be the full package of severance benefits that a company would provide for an involuntary termination without cause by the company. Sometimes it might just be equity vesting, no cash severance. And then sometimes it might be something in between the full severance benefits and what one would get if they walked away with nothing. Something in between, and just to ensure an orderly departure. So how are the proxy advisory firms reacting to this? Well, this has become an area of increased focus by both of them, ISS and Glass Lewis. ISS has been a little more categorical about their stance against this, a little more vocal, and they will explicitly label severance practices as egregious pay practices that may warrant a no vote if they are not associated with something the company has disclosed as an involuntary termination. Glass Lewis might not be as categorical, but they've made clear that they view this as an unfavorable pay practice. And ISS has even highlighted in their comments that if there's a termination, they view it as a problematic pay practice that carries significant weight and may result in adverse vote terminations anytime it's not disclosed as involuntary. And specifically, if you've included ambiguous language or you've used those step-down terms or mutual agreement on a departure, those are the kind of things that are triggering their reaction, and they've stated that that is contrary to a performance-based pay policy. It carries significant weight, may result in an adverse vote recommendation. Kat, we'll talk a little further with you about it's almost an always will carry an adverse vote recommendation now, and they've also said it's just simply not appropriate.
So the question is, what do you do? Because for my clients, this has been a real practical problem, right? For all the reasons that Regina was saying. So we're here, we understand this is the landscape. What do we do? So the answer is, we have a few, did we skip? Let's skip forward here. There we go. So if you have a payment or vesting pursuant to an agreement, let's say a severance plan or policy, an employment agreement, your equity awards are written this way. If you already have something in place, this isn't negotiated on the way out, this is already in existence, and you pay pursuant to that, then so far, we have seen no pushback from ISS and Glass Lewis. That doesn't mean that won't change, particularly on involuntary events like a retirement. But right now, we're not seeing pushback on that. It is on payments that are negotiated on the way out. So that means that if you have retirement as a vesting trigger in your RSU agreement and the RSUs accelerate on retirement, so far we're okay there. A second option is to provide a lot of detail. Tell your story. Why is it that you're paying this particular person on a voluntary termination? You could have a really compelling story there, and you need to make sure you're sharing that in a way that is both visible and concise and clear and compelling. I will tell you that I have had some very compelling reasons for making some of these payments that I think were disclosed and beautifully written. And we still got the no vote. So, sometimes that works. I don't know if it's because sometimes it's more compelling than others, or sometimes ISS is paying more or less attention. But we can't promise you that that one will be a slam dunk. But it's worth a try if you're already there to put your best foot forward on the disclosure. And then the last is essentially to wait until you're outside the disclosure window to make a payment. So maybe someone steps into a non-executive role for a year or two. Maybe someone steps into a consulting role. You cannot make them any promises at that time, otherwise it doesn't work. But if they hang around and you guys decide in the future, when they are not subject to these disclosure rules, 8K or proxy, you need to think about both because they have different timetables. Then you can make a payment on the back end as long as there's not a promise during the time that they are subject to those rules.
So that one obviously involves some trust between the executive and the company, the board.
And some time.
Right, and some time. It's both of those, because you can't have anything contractually promising those benefits at the time that the separation occurs. And then also, of course, if you're willing to say this is an involuntary termination in your proxy, and it's pursuant to your previously disclosed arrangements, and that's not going to be a problem either.
And something else to consider is that ISS will deem it to be a voluntary if it is not clearly disclosed as involuntary. So, this has been an issue from internally with some of my clients where they kind of wanted to soft play the language. You can't soft play the language. If it's involuntary and you want ISS to know that, you need to make that very, very clear in your 8K and your proxy statement. So the main takeaway is if you're wanting to pay on things like retirement, I would suggest you talk to your attorneys and your advisors and you go ahead and you put that in the agreements. For right now, that works, and doing it on the front end rather than on the back end is the best way to go.
And you have options on how you would define retirement. There are some companies that do that by reference to reaching a certain age. Others might have a combination of age and years of service. And then you could add further requirements if you just need a little bit of flexibility to determine if it is really appropriate for that particular person who's retiring, where maybe the retirement has to be for someone who's in good standing at that time, that they've provided written notice and allowed for a smooth transition. There could be a timing requirement for the written notice, like so many days of advance notice of an upcoming retirement, and agree to be available to transition to their successor, or having board approval for the retirement vesting. Okay, moving along to perk disclosures, and everyone's heard plenty about perks over the years. The SEC loves to go after perks. It's a splashy headline too. It gets a lot of attention in proxies. We thought we'd just touch on some recent developments here, and in particular, and I may skip over some of this, like what is a disclosable perk, et cetera, because we don't have as much time left in our presentation. We want to make sure we hit on some trends that we are seeing evolve. So let's go on to what is but basically a perk is any item that provides a direct or indirect benefit that has a personal aspect, even if there might be a business purpose associated with the payment or benefit, or it might be for the convenience of the company. Unless it's available generally to all employees on a non-discriminatory basis, it would be treated as a perk. There are some dollar limitations that will trigger the disclosure. We have a $10,000 rule and a $25,000 rule. Some of that may be a part of what the SEC may want to change. We know we have some commentators that have come forward with comments on the SEC roundtable that they think that those perk limitations might need to be
yeah.
increased as time goes on. All right, but just to remember from this page, it was over 2 decades ago that the SEC famously said in a speech, all means all with regard to perks. So if you think there's any doubt or gray about whether an item is a perk, the SEC probably considers it a perk.
Yeah, I would say you should track anything that's even remotely questionable and then come to your advisors, your attorney and say, here's the list I have. Tell me which of these is a perk and which isn't. But the answer is almost always going to be it's a
Oh,
perk.
why am I? Did not mean to do that, sorry. Okay, we've seen some recent SEC enforcement action on this. One was against Express Inc. The SEC went back 3 years and found over $1 million worth of perks that were not disclosed, resulting in a 94% underreporting of compensation. A lot of this had to do with use of private aircraft for personal purposes. It ended up settling without monetary penalties due to the company's cooperation with the SEC. Then Stanley Black & Decker, they had another situation very similar to Express that's happened recently. Here, the SEC went after not only the company's disclosure practices with respect to the executives as a whole, but also they found that one particular executive in particular failed to report almost $500,000 worth of personal benefits attributed to his use of the company corporate charge card for personal expenses. Now, here's a recent trend that Kat's going to discuss regarding security for executives.
Yeah, so I think this is going to be something that we're going to see a lot in this next year's proxy season, which is an increase of disclosure of security costs as a perquisite. There already was sort of a rising level of reporting that and a rising level of providing it. But I'm sure that everyone heard about the incident at United Health in New York in December of last year, where the CEO was shot and killed. And I know from my experience that got a lot of people's attention in the boardroom. And I think that a lot of companies took this year to reevaluate the security that they're providing their executives. And I think you're going to see a big jump in providing that benefit and in disclosing it.
Yep.
This was something that was a big hot button issue at the roundtable. Security is a perquisite, personal security, and a lot of people feel that it shouldn't be for a myriad of reasons. One, because it is the reason they need the security is almost always because they are in that position. And the second is that disclosing which of your executives have and don't have security is in and of itself a real risk, right? Because you're highlighting, this is the executive who has personal security and these are the two that don't. And so that's a security concern in and of itself. So I think when we see changes to 402, that's going to be a change that we see. I would be surprised if it wasn't.
The important thing about perks is that the company has disclosure controls and procedures. So the SEC is interested in you having a process and making sure you understand what you need to be doing to evaluate whether something is a perk or not and needs to be disclosed.
Yeah,
So
if
we
you
would
don't
say-
feel like you have a good process internally,
Right.
reach out to us and let's coordinate a review of that, because that is something the SEC is very focused on.
Okay, so lastly, in just 1 minute, we will just want to mention that ISS has already issued their proposed changes to their policy for compensation for 2026, that would apply for 2026. They have requested comments. The comment period closed yesterday. The formal publication of the new rules has not yet occurred, but it will be forthcoming. There were 5 things identified as areas where there's some small tweaks. So we'll be on the lookout for those. Maybe some of the bigger items from that is that we've had focus from them that most of your awards need to be performance-based, not time-based as far as equity awards. And now they are signaling a willingness to shift toward allowing more time-based if there's a longer horizon, so that the majority of your awards could be time-based, or even all of them time-based if there is a longer horizon to them. They didn't really quantify what a longer horizon is, but that would be something that would be tied to vesting or to retention. Once you have purchased, received the stock, that the executives have to hang on to it for a certain period of time. But we should be getting more clarity soon when they publish their final rules.
Yeah, it'll be interesting to see how that develops and how many folks actually sort of follow that path. I think part of the challenge there, a lot of companies would love to do more time-based awards. I think the challenge is if they have to be over a longer period of time. I mean, I think
Like 5 years or so?
I think the average CEO tenure is something like 7 years, and I think the median is something less than 5. And so will those long-term awards really hold value for those executives? Will they work as a retention tool, or will they kind of write those off as something I may never see? Because 5 years from your start date, in year 2 and year 3, you're talking about 7 years and 8, right? You're pushing it further and further out, and I'm not sure that realistically reflects the sort of employment patterns that we have for publicly traded companies, at least. So, all right. Okay. Does anybody have any very quick questions? All right, well, I'm going to sit right here and I'm going to ask Robert to come hang out with me for a little bit, and we're going to talk about restatements and clawbacks. Thank you, Regina.
So this is where you get excited because you know that the end is near. Just like that crazy-looking guy on the street corner says in his sign.
We saved the most exciting for last, though, I promise.
We've talked about comp, and this is uncomp, decomp. Decomp. So we're going to just spend a little bit, try to focus in particular on some of the practical issues you hit into in clawbacks, but let's just remind you about a few things that are going on, because we just went through 10Q season for a lot of people, and it's somewhere in the client base, somewhere out in the public reporting world, somebody had a bad week. And that bad week can come for a lot of different reasons, but one of the reasons is the possibility of a restatement. Maybe it was a disclosure issue that came up. Maybe the accountants just were rethinking some things, wanted more information. But this is one of the areas, the potential restatement, where you see a couple of things slipping away. One is the likelihood of hitting your target for your earnings release and call. The other is the possibility that you might actually be late in your quarterly or your annual report. And then, of course, we've added all the things that can happen from that, with the possibility that you might have to go and tell your boss that he owes money back to the company. And that's never a fun conversation. So when you've got an error in your financial reporting, and it's material, the company is required to submit a restatement to correct that error. Now, first caution is that materiality for accounting purposes is not the same as materiality for SEC purposes. I hope by now most of you know that, but accountants think about materiality not just in the Basic versus Levinson standard of whether a reasonable investor, of which we know many, would view the information as substantially altering the total mix of information. But they really think about it in both numeric and qualitative, so quantitative and qualitative terms, to think about whether or not the presentation of the financials on the face of the financial statements is materially wrong on any line item, and not just in the aggregate or on a bottom line or whatever. So even errors that are category errors that don't affect the bottom line can still end up requiring some restatement issues. Not surprisingly, these do often come up, almost always during the start or the end of the year-end audit process, or the start or end of the limited review that auditors are required to make in connection with a 10Q. And I hope you all know that a 10Q that is filed, but the auditors never did what we used to call the SAS 100 review on the numbers, is not considered by the SEC a valid and timely filed 10Q, even though there's no consent or letter from the auditors that goes with a Q, as there is with the K. So that's when they come up a lot. That's one reason why a slide we skipped in the first presentation is sort of interesting, because one of the things being kicked around, and President Trump has signed an order asking the SEC to look at this, is rolling the clock back to pre-1970, when U.S. public companies reported on an annual and semi-annual basis, as they are required to do currently in the UK and Australia, and getting rid of quarterly reporting. Well, even in UK and Australia, a lot of companies put out quarterly numbers, but in a more abbreviated fashion than we would do it in a 10Q and without some of the extra disclosures. There's some interesting regulatory ripples on all kinds of fronts if we go to semi-annual reporting, like when does your trading window open and close? Will there be a rule that says quarterly information is not material because maybe that quarterly window is now going to be closed for much more than a quarter? Or do you go ahead and release it anyway, and what are your investors going to require? Companies that have gone dark, have gone private through a private equity buyout, have learned a sad reality, which is they've gotten rid of these quarterly public reports, and now they're providing monthly and weekly reports to their private equity owners. So there's a lot of demand in the market for quick information. It'll be interesting to see how they do that. But maybe a benefit would be that there would be less opportunity for the restatement issues to arise, because now you're only doing a semi-annual limited review and an annual audit, and maybe you actually have more problems, because when you do find the problem, they've gotten bigger than they would have if you looked at it every quarter and found it before it got big. So who knows on that one? But the game usually goes where somebody has identified the problem and it's floated up and made its way to the chief accounting officer or the chief financial officer. And then we've got just a little list here on this slide of some issues you just are in a scramble to try to figure out very quickly, in the what if we can't get the auditors signed off, or what if we can't figure this out quickly? Are we going to delay our press release? Are we going to delay our conference call? If we do that, what are we going to say about why we're doing it? Because the market will almost always assume something terribly negative. What if we're late? Got to file a 12B25 if we're late. And what are we going to say about the period that we're not ready to report on, given that Form 12B25 says you've got to say what your material changes are in your financial results. So it's forcing you to pre-release and therefore tripping the item 2028K. How do you have the time, especially in the Q period, to go through a good process to figure out whether you do have a restatement? And who's the ultimate decision maker in your company on that issue? Is it your CFO? Is it your CAO? Is it your audit committee? Do you have any document that's clear about that?
I was going to say, it's actually interesting, because when we were implementing all the clawback policies, when we asked our clients this question, because that has to be in your clawback policy, who is in charge of deciding whether or not there's a restatement, I would say 70% of my clients had no idea. So
we'll just repeat a recommendation we've made in past years. Your audit committee charter ought to make them the sole decider on whether or not you're going to withdraw reliance on financial statements for item 402 purposes of 8K. And it ought to make them to be the decider of whether or not you're going to restate your financials. You won't find an SEC rule that requires that. You won't find a stock exchange rule that requires it, but it's the practical implications of how the 8K is written and the processes you have to go through. That's probably where you want to put it. So we would encourage that. Okay, so, and then just a reminder, no 144 sales when you haven't filed your report once it's due, but you probably ought to have your window closed already for other reasons, so I hope that's not an issue. Okay, restatements generally have decreased as a percentage of public companies. We see a high, sort of a high mark early on. We'll explain that, in a blip in 2021, but also take into account that part of the reason here is that your percentage of companies that are SPACs, pre-DSPAC, and your percentage of companies that are foreign issuers in this selection has moved up over that period. So maybe when you adjust those things out, it may not be as good a decrease as it looks like. In the kind of the 2005-06, we were still dealing with the option backdating, revenue recognition issues that were being identified in part because of the Sarbanes-Oxley attestation on controls and other issues that were also identifying problems. And then that's when the SEC, through comment letters, overrode the accounting literature and the accounting profession on how you amortize leasehold improvements and changed the rules. So there were a whole bunch of restatements that clustered in that time period, kind of dropped down nicely. And then the 2021 spike is mostly in the SPAC world, where the SEC changed its view. Look, it never changes its view. We just always misunderstood it, and if only we had asked. So they let people know that the warrant accounting in the SPAC world was unacceptable and needed to change, and that resulted in a bunch of restatements as opposed to just doing it go forward. If you were telling your internal audit team what they really need to keep their eye on, here's the top 10 ranking of causes of restatements by percentage and number, basically in the last 20 years. And it's surprising how, in some cases, some of the same issues come up over and over again in different companies. So there are three kinds of restatements. Colloquially, we talk about reissuance restatements, or big R, capital R restatements. Those are always scary. And then there's the revision restatements, little r, meaning that you probably aren't withdrawing reliance. And then there's out of period adjustments. So the big R restatement, you've got an error or a combination of errors in previously issued financial statements that are material to those previously issued financial statements. And that means you've got to go back and change all the filings where it's material and clean it up. And in some of these cases, that's multi-year. So you might end up doing what we call a super 10K instead of separate 10Ks that otherwise are required. And there's SEC letter to the CFO guidance on that now that's been out there quite a while. We say often here, I'm going to say almost always, this will involve a withdrawal of reliance on prior financial statements and the 402(8K, but which is, by the way, one of the ones that cannot be buried in the item 5 of your 10Q or your 10K. It always has to be done by a separate 8K. And often we find it takes a while to really figure out the problem over prior periods and sort it out. And as a result, the company doesn't file its next periodic report. We've had, cases in companies that have sometimes gone years before they can file a correction. Sometimes it's a mere year and a half. So that has a waterfall of other problems to your registration statements, your ability to do compensation awards or allow exercise, all kinds of interesting issues, including, do you continue to report your quarterly results on a preliminary, subject to whatever this investigation shows kind of basis? A lot of interesting questions there. Big R restatements have generally decreased, with the caveat we've noted there again for our friends the SPACs. Little r restatements are errors that were not material to previously issued financial statements, but would be material to the current report you're trying to issue, and you need to fix it. So that's good, but sometimes these result in delays while people figure it out for the current period. And when it is published, it's usually explained in the notes to the financial statements and sometimes in MD&A, especially where it creates differences in comparability among periods. So again, there's some data for you on the little r restatements. And then the last thing, the out-of-period adjustments or the recasting, sometimes we call that, is immaterial errors and misstatements in the current period to clean up stuff from prior periods. And you're doing that because what you'll see in the analysis here in a moment is that you're trying to wipe out the roll forward effect of mistakes and stop them from adding up to where one more little mistake tips you over into materiality. So when you have an opportunity to clean up, when you've got to anyway, you try to clean up a lot of stuff to reset your what do we know is an error, even though it's immaterial, back to as close to zero as you can get. By the way, all of these involve an analysis of material weakness, and a big R restatement always will result in your saying we had a material weakness, and a little r restatement will almost always. And an out-of-period adjustment may result in your concluding that, in fact, you did not have effective internal control over financial reporting and potentially disclosure controls that were effective during these periods. So this one I will move through briskly because our goal is to let you have the pleasure of hearing Catherine be among the last words you hear, and her voice is so much nicer to listen to than my nasal droning. Just be aware, we've given you details, but be aware that FASB Topic 250 is the document that the accountants are going to look at, and then the staff has 2 staff accounting bulletins that they expect everybody to look at as well, SAB 108 and SAB 99. And SAB 108, I'm going to characterize as a quantitative analysis, and it makes you run that analysis both for the current period and then the cumulative effect. So that's the Iron Curtain, is just the current period. What does it do if you fix it all in the current period? And then there's the rollover. What happens if you roll it through the periods and you accumulate the issues you know you have into the current period? You analyze this 2 ways to assess whether you've got a restatement. And then SAB 99 is qualitative. Even if something doesn't hit your qualitative standards, your quantitative standards for restatement, it might still qualitatively drive the accountants to conclude that there ought to be a restatement because it involved fraud by somebody high up, or because it materially affected compensation, for example. I mean, there are a variety of things. So we've listed those at the bottom: masking trends, whether or not you complied with your debt covenants, would the numbers change whether you're in default or not? But you have to run through all of these qualitative assessments. And what you're going to end up doing when you're looking at a restatement is almost all the accounting firms, certainly the major ones, expect to see a written document that they'll review with their national office and that you're going to provide after legal review and internal and external accounting review to your audit committee. And so we've given you a sample outline of what might be in it. Now, some of these points you may not be able to address in your first memo to the committee. Some of them you deal with a little bit later, but this is basically what you're going to lay out and get on paper as your contemporary evidence of what your independent directors thought about and understood as they assessed 2 things: whether or not there was a restatement, what kind it should be, and then whether or not they're going to withdraw reliance on prior financials. So there's your sample memo over 3 pages. It's a long memo. And we've already talked about Form 8K disclosure. If you do withdraw reliance, you've got to file that. The staff's view is that you don't have to file withdrawal of reliance on every restatement, big R, but you're you should be expecting a comment from them asking you to explain why you didn't, because they think you should, usually. Be pretty hard to win their argument. Okay, so Catherine, that's what my world deals with, and it's all panic and whatever. And
I'll say, that sounds like all sorts of fun.
oh, it's great. It's great fun, just almost any time of day or night for at least a few days of panic, and then hoping that it actually ends instead of stretching out. But sometimes it stretches out and gets worse and gets worse and gets worse. And maybe it'll get better after they bring in an independent counsel who says, fire everybody in accounting and fire that lawyer too, because I don't like him. So they do all that. But now the law says, we need to bring you into this joy and excitement to tell us whether or not we've got to tell our bosses that they've got to give some money back to the company, because that's just the way it is. Even if they weren't involved in
Oh, absolutely. Yeah.
whatever, they didn't do the currency exchange accounting between Brazil and the United States, but it's their comp at risk here. So what do we do when we come to you?
So I will say, please reach out to your counsel early when you start to realize that you may even have these issues. And if you're at V&E, they will absolutely know to call me or another member of your exec comp team, because it is much easier to deal with these issues the earlier we know about them. Okay, so what do we do once we get involved? If you have a big R or a little r restatement, then you're going to need to consider whether or not you have to claw back comp. So you're basically going to have to engage your clawback policy, right? You're going to have to make an analysis under it. And your analysis may be, there is no comp that we need to claw back. In fact, most of the time that's going to be the answer. We can talk about why here in just a second. But you do need to do the analysis. And so what does that look like? You need to figure out who, what, when, what the effect is and how much. That's an oversimplification, but we're going to start here. So as far as who, what I mean by that is which executive's comp is subject to the clawback policy under these facts. And there it's going to be current and former executive officers. Strangely, they decided to make the definition of executive officer bespoke. They didn't reference another already existing definition of executive officer, of which we have a few. But essentially, it's the Section 16 definition. So it is going to include your chief accounting officer. In case you're wondering, he or she gets yanked into this too. And it can include former, so they don't have to be currently employed. You can come after somebody who is no longer there. The what is what type of compensation is subject to clawback. Are we talking bonus? Are we talking time-based equity? Are we talking performance-based equity? Are we talking about that bonus you gave Todd last week? So you need to sit down with your exec comp attorney and work through that. That can be sort of a complicated question. Given how much time we have left, we're not going to dive into that today, but you should give us a ring and we will help you do that analysis. As far as when, there is a 3-year look back from the time you decide you need to do a restatement. That also has some details to dig into, but that is the overarching rule. That is the high level answer to that question. But it's going to be comp that is received during that period. And of course, received has its own special meaning. So for equity, that generally means it vests during that period. For something like a cash bonus, that's generally going to mean it was earned during that period, not necessarily paid during that period. Again, there is more detail to dive into there, but that's the high level answer. Then you have to decide what is the effect. So we figured out which comp we're talking about and who it applies to, but do we actually have to claw anything back? Okay. And the answer there is going to be, what caused the restatement? What did you have to change? Okay. And is that thing that you changed, does it create a different answer for the comp that you paid out, or does it not? And a lot of times this is going to be a very simple question to answer, right? Because if you changed thing A and thing A is not in any way, shape, or form a metric or a consideration upon which you awarded comp during that time period, you have answered your question, you are done, okay? If it is, something that is an element of your, let's say it's a metric in your bonus program that was modified in the restatement, or we're going to get to TSR and stock price here in just a second because that's the complicated one. Then you have to rerun the calculation with the new number and see if it spits out a lower number, okay? If it does, then you're going to need to claw back that compensation, okay? Let me see what our next... Okay, so this is part of what we were just talking about, which is that recalculation is often straightforward. The question is, when is it not straightforward? And the answer there is generally when we're talking about stock price, which includes TSR, total shareholder return, relative TSR, which is where you're comparing your company's TSR against a peer group's TSR. These are very common in PSUs, performance share units. And so a lot of people are going to have to answer this question. And that may be a complicated question to answer, or it may not. It depends, which is, I know, your lawyer's favorite answer. But what does it depend on? Okay, so let me give you a really straightforward example where I think you could very reasonably come to the conclusion that it did not, the stock price was not impacted by the restatement. Let's say you have a restatement and you announce the restatement, you issue, your correction, and absolutely nothing happens to the stock price, or the stock price goes up, okay? I think you can, and you watch it for a little while and that trend continues. I think you could reasonably come to a conclusion as a comp committee that this change did not impact the stock price. Where I think you get into a much more complicated question is, let's say you announce this and your stock price takes a dive. Then I think you're going to need to think about some more complex analysis to perform there. And that can look like a lot of different things, but the most straightforward way to do it is probably to engage a third party to help you do that analysis. And generally what they're going to want to do is an event study, which is something that up until now, usually people have only encountered in the litigation context.
Very similar. Very similar to securities damage type models.
Yes.
In 10b-5 litigation.
And that is generally not something that you can do in-house. Personally, it's not something I would recommend my clients even try to do in-house, because we are going to want, when we have a more complicated question like this to answer, you're going to want to make a really good record in particular. I mean, you always will, but especially in these circumstances, a really good record of how you figured this out, what your process was in figuring this out, who is involved in it, and why it is reasonable, because you're going to have to disclose that, which actually we're going to get to here.
That's what I was going to ask you. What's going to go on? Is this all behind the doors, or do we actually have to say something somewhere?
We do have to tell people about this. So there's a couple different things we have to do. In the 10K itself, there is a little box that says, did you have a restatement where you have to engage your clawback policy? Did you have to do an analysis under your clawback policy?
Did you have a restatement that resulted in a recovery or clawback analysis? Is the word that's actually on that legend on the cover of the 10K, along with all those other boxes that you may or may not have to check?
And so the answer is yes. If you are doing a little r or a big R restatement, you check that box. You don't even have to think about it. That is the whole thought process. Are you doing it? Yes, the box gets checked. It is not asking whether or not you have to claw back comp. It is asking whether or not you have to think about clawing back comp. So you check the box. The next thing you're going to have to do is in your proxy statement, you're going to have to include the disclosure under 402W, okay?
By the way, we should all pause and say, really? W? And there's an X after that's in there as well? The authors of Plain English have a rule that goes to 402X.
We won't even talk about how many pages those are, too.
Yeah, it's crazy.
Which is why we're reconsidering them, right? I really do think we're going to see a simplification of these rules. And I'm kind of excited about that, in case you couldn't tell. But W is where we're at on this one. And what we have to do here is pretty much what you would expect. So we have to say, hey, there's been this restatement. Hey, here's the comp and the people who are subject to this analysis. And either we decided that we don't have to claw anything back, and here's why, or we decided that we do have to claw some things back, and here's why, or we're still figuring it out, also an option.
How much detail should people put in on that issue? I mean, if you decide that you don't need to claw it back, is it fine to just say, and we had a restatement on such and such a day, and we concluded that there was nothing affected by it, the end, as my grandson says, the end.
I think you at least need to give a little bit of a why, right? And a lot of times the answer is going to be because that measure that was changed in the restatement was not used anywhere in our comp, okay? And so that's a simple answer, but you should probably say that, right? You need to give some kind of explanation. A lot of these disclosures are very, very brief. I'd say half a page, maybe less. Where they get more complex is where one of those metrics was implicated. Or where you have a share price measure like TSR, where you have to engage in that analysis. And the rule specifically says that if you have a share price, I think it may be on the next slide, where you have a share price analysis, you have to use a reasonable measure and you have to explain it. So you are going to have to do that. Now, sometimes you have a big old explanation and the answer is still $0. Okay, you will see that. This is such a new rule that people are still developing sort of the normal way to do this disclosure, the typical way to do it. And so right now you're still seeing a lot of variety in what this looks like. And that's kind of fun.
And is that the end of it? I know you're asking that, is that the end of this program? What I meant is.
Almost.
Almost. What I mean is when the comp committee says, okay, we've done all this and we've decided no clawback, or this is the amount of the clawback, and we make this disclosure, maybe they push to say the absolute minimum. Is that the end? Is that the end with the SEC? Is that the end of it with everybody? Just done and you move on?
Under the circumstance where you have money to claw back, you do actually have to claw it back. So if you have not yet done that, you need to do that. If you still haven't done that by the next proxy, then you're going to have to explain how much is outstanding, who hasn't paid you back, what's going on with that. So that's an issue there.
So there's a disclosure consequence, but there's no second guessing on this from regulators, from anybody. Is that what you're?
We're going to find, find out.
Oh, we're going to find out. What do you think?
There shouldn't be, but I would not be surprised at all if we don't see some shareholder litigation around this, okay? Particularly in circumstances where more analysis was needed. It was a stock price measure, and the committee came to the conclusion that either no clawback was warranted or a very tiny clawback was warranted, and it was debatable. I think that's where it's really important for you to have an excellent process and excellent documentation of what your process was to prove, hey, we did our fiduciary duty here. We came to a reasonable conclusion. We used reasonable measures. We were thoughtful. Engaging that third party under those circumstances can be very helpful. I think those are things you can do to mitigate that risk.
Yeah, it seems to me like there are two kinds of private causes of action. One would be a disclosure-based cause of action, that your disclosure around this is really not accurate. You didn't have a reasonable basis for some of this. And then the other, it seems to me, is just simply it's a derivative claim on behalf of the company that it should have clawed back stuff, and that the board, the comp committee, somehow didn't satisfy their duty of care in how they approached it, and therefore money was owed. So
the last thing I'll note in answering your question is that, these clawbacks are of pre-tax dollars. So let's say you had $100,000 you paid to your CEO and you need to claw, half of that back. He's already probably spent the money, and B, paid taxes on it. But he needs to pay back the entire amount that you're asking for. It is not an after-tax value. And so that's something that during the clawback rule process, a lot of people commented on, saying it was unfair because they never received that full amount, right? Some of it went to the IRS, but that is the rule. And so you're probably going to get a lot of static from your executives if you have to claw back money on that particular point, and they're going to need to work with their accountants or financial advisors to do the best they can to recoup that loss in the taxes that were paid. That can be a complicated process, trying to get those dollars back. Usually you can get some of them back. Sometimes you can't get all of them back.
I guess you can withhold from a current employee, but you've got to go chase down a former employee to deal with this. Well, as Catherine Frank said, weird things happen all the time earlier in this program, and that's true. We hope you don't have to deal with this. But as my grandson says, the end. Thank you for being here.
Thank you so much, guys.